Good morning, dear friends. Fourth session on Ind AS 115, that is recognition of revenue. I mean, the standard name is revenue from contracts with customers. Very important standard. A five-step based model. We have covered the first step, that is identifying the contract. Identifying the contract. The second step also we have covered, that is identifying the performance obligations. And now we were doing the next step, that is determining the transaction price. In determination of the transaction price, we have already discussed variable considerations. Variable consideration could be a positive consideration like a performance based bonus. It could also be a negative consideration like a penalty, provided it is related to your performance. I told you that there is a carve out between Ind AS 115 and IFRS 15. IFRS 15 considers all the penalties, including performance based penalties as well as penalties of a protective nature. Whereas in the case of Ind AS 115, we take only performance based penalties, and your protective penalties are ignored in estimating the variable consideration. So this was done. How do we move about with variable consideration? Well, we look, each consideration will have two parts: the fixed price that will be factored in your transaction price, as well as the variable part, which is our bonus or our penalty. In the case of the variable part, we will again segregate it into two components. The one that is not subjected to constraints. Like for example, I'm having lot of experience in the construction industry. Okay, so companies like Larsen and Toubro, all your big companies are covered here. So therefore, they can make a fair estimate of within how long they can complete the contract. So in the example that we discussed, if 2000 crore is the value of your contract, and for every month of early completion 20 crores you're going to get the bonus, your time period for the contract is say 5 years. You estimate, a company of the stature of Larsen and Toubro estimates that it will complete the contract within 4 years, then it can estimate the variable consideration as 20 per month into 12 months of early completion, 240 crores, and take it in the revenue. So the total booking will be based on 2000 plus 240 crores, 2000 plus 240 crores. This is a departure from the conservative estimate of accounting that we used to follow previously, because here we have a backup of past experience. So the standard says, give a fair picture, give a true picture. Do not run behind conservatism to such an extent that we are understating our revenues. Okay, so this is the important change that has been brought about in our accounting. We are moving towards a more realistic form of accounting. Okay. Then, however, if this is subjected to constraint, if the variable consideration is subjected to constraints, what do we do with that? In that case, we will not include. Subjected to constraints means what? Like, I do not have adequate experience, or my consideration, my bonus is based on factors which I cannot control. Like, for example, what we discussed market-based bonus. Okay, suppose you are an asset management company, you are entitled to an incentive depending on how much better you perform as compared to the market. So nobody can predict the market, and because nobody can predict the market, your performance bonus cannot be taken as a part of your variable consideration. It is still subjected to constraint because the market performance cannot be estimated. It is beyond our control. Okay, so this was what was the variable consideration portion that we discussed. Sir, what will happen if in the case of the L&T similar contract, I do not complete within 4 years? I have to go beyond the 4th year because of reasons beyond my control, or because of something I could not foresee. Well, in that case, it is not an error, neither is it a change in accounting policy. It is nothing but a change in estimate. So you will do the treatment prospectively. So this was what we discussed about variable consideration relating to bonuses, etc. The principle is what? Include it in consideration if it is not subjected to constraint, because the very definition of transaction price is what? The definition is not the amount that you will receive, but the amount that you expect to receive. That means it is tilting towards some fair value based accounting. All right, so this is why that those words are important, and variable consideration has to be read in conjunction with those words. Okay, so this is what was variable consideration. Then we saw two small cases. One is your warranties. That means warranty given in respect of goods. So warranties are of two types. Either you are having the intention to get the income from warranties. You are offering warranty as a separate service also. Like for example, you go to a vehicle showroom and you buy a vehicle, then the vehicle will normally come with 2 years warranty. Suppose for example, and they say, sir, if you want 1 more year warranty, you have to pay so much rupees extra. Now that means what? They are selling an additional amount. They are selling an additional service for a separate consideration. That means they want to make warranty as a separate stream of income. If that is the case, warranty becomes a distinct service. You will have to allocate the transaction price between the between the value of the car and the value of the service. Okay, the very first example that we discussed when we started to do this standard, you allocate it and separate the streams of revenue between sale of product and sale of the warranty services right from the source itself. Do you have to make a provision for warranty costs based on the estimate of the cost? And the answer is no. Why? Because you have already segregated the component. So what are the costs that are incurred? They will automatically be matched with the components. You do not have to estimate a provision. You do not have to estimate a liability, estimate a warranty cost in this case. Okay, so this was the point of warranty. Some warranties are not in the nature of a separate service. They are in the nature of an assurance. Okay, warranties are not sold separately, but there is an assurance, like if anything goes wrong, we the manufacturer will take care of your product if it goes wrong. So it is just an assurance, not a separate service. So you do not segregate them, you will take them together. And now we will do the treatment what we used to do earlier, make a provision for warranty costs. So this was relating to warranties. Then we discussed sale or return. In sale or return, there was no clear guidance under the earlier standards, but under the Ind AS 115, there is a very good guidance that is given, only because the words used are expected consideration. Okay, that is transaction price is the expected value that you expect to receive, the entity expects to receive. So suppose if an entity sells 100 cell phones through Amazon or Flipkart, it will make an estimate of how much it expects to return if the cell phones are returnable, and basis that it will recognize the revenue as well as a refund liability. The refund liability will be at the selling cost, at the selling price, and because you are estimating a refund liability, those goods will come back to you. So you will have to also estimate a you will also have to account for a refund asset. In this case, the inventory that is lying with the customer, which you expect will come back to you. That asset will not be recorded at selling price. It will be at cost price. Why? Because you cannot measure your inventory at market value. It has to be at cost. Sir, what if it goes below the cost, the NRV? Then you take the NRV. Then you take the NRV. Okay, so this was what we had seen. A new concept was also introduced in the last session that was relating to restocking fees. What do we mean by restocking fees? Well, suppose if the seller is based in Delhi and he has sold his goods somewhere to Kanyakumari, then if there is a return request from the customer in Kanyakumari, there will be substantial costs incurred to get the goods back from Kanyakumari to Delhi. So what the seller will say in the terms of the contract, look, I am selling you and I am giving you a right of return also. But suppose you choose to return the goods, you will have to bear the cost of the transportation to Delhi. That cost is known as a restocking fee. Why do we use the word restocking? They are in stock with the seller. He made the sale. Now he is getting back the inventory. So he is restocking. Okay, so he is again stocking it back with himself. So this restocking fee, when you estimate a refund liability, at the same time, you will also have to estimate the restocking fee income. We saw that small example where when you get the goods, when you sell the goods, the entry will be bank account debit to sales, the proportion that you expect will be sold, to refund liability, that is the amount that you expect will be returned. Then you will pass the entry refund liability account debit to restocking fee income. This is the income that you will recognize. The refund liability will appear at the net amount. That is the amount that you expect to refund minus the restocking fee that you expect to receive. And then of course you make a provision, you record for the refund asset in the usual manner. So this is the treatment relating to sale or return as well as restocking fees. Now the next thing that we had discussed was a significant financing component. Okay, so sometimes it is possible that your goods or services, you are giving credit which is longer than the normal credit period, So the standard now tells, if that is the case, there is a rebuttable presumption that you have given a financing. Typically when this would happen, when the time span between the performance obligation and the payment of consideration, the time span between this is greater than 12 months, there is a rebuttable presumption that you have given a financing. Fair enough. So now at this point of time, the standard says there is a financing component. However, the standard has also said that there are some cases, it has identified 3 cases where the financing component will not be there even though the credit period is more than 12 months. Examples of those include, first one, services of a discretionary utilization. So like for example, you take a prepaid card and you recharge it for 3 years. Does it mean you are financing the phone company? Answer is no. It is for the use of services that you will do over 3 years. So no financing is there. This is a plain sale transaction, number one. The next one is to protect your interest. It could be either protect your collectability. It could either be protection of your collectability, or it could be even like for example, the rating of the customer is not good. Therefore, you are not certain whether he is worthy of credit. So therefore, what you do, you ask him to pay up in advance. That payment in advance is going to be treated as a regular consideration, not as having a finance component. Okay, so this was what we had done in your exceptions. All right. And last one was, if the consideration is variable and the variability of consideration is beyond our scope of determination. We saw the example of the royalty. All right. So royalty is based on the number of copies sold. I will get to know only after a period of 2 years. However, the rights to publish that book, the content, the manuscript that is there, that is already given to the publisher today itself. You will get the consideration after 2 years. So though there is a time gap of more than 12 months between the obligation being performed and the consideration being received, there is not going to be a financing component because the nature of the consideration is highly variable. We cannot estimate it. It may be a bestseller. It may prove out to be a flop book as well. Okay, so this was what we had discussed previously. Okay, now let us move on. I had asked you guys to do some theory questions. Have you tried those questions? 41 to 47. Could you do those questions, friends? Yes. Good morning, Anjali. Could you do those questions? Just a minute. My board has shifted a little bit. Just a second. Yeah, this is fine. Okay. Did you try those questions 41 to 47, friends? They are simple theory questions. I hope you would have done them. It was an expectation. Achha, before I forget, one announcement. Today the standard as per your schedule is your last day. However, we still have the 5th step and the 4th step. So what I am doing is, tomorrow I will be recording the remaining portion of the standard, which will be hosted to you as soon as the institute does the recording. Okay, so therefore kindly view the recorded portion also. I requested the institute because I did not want to hurry up with the syllabus. Okay, so therefore I felt that you may need to go a little bit slow. I did not see any point in hurry, and the institute was kind enough to agree to my request, and at a very short notice they have scheduled a recorded session for me. So I will do the recording of whatever is left, and that will be hosted on the portal as well as the YouTube. So I request you all to kindly view the recorded session as well. Okay, so don't think that I am leaving the standard incomplete. it will be completed by the way of the recorded lecture. Okay, so please view the recorded session. All right. Anybody has tried 41 to 47? Anjali, Ambika, Purushottam, guys, not tried? Not tried? No answer. Anyways, let us come to our study material. Okay. Yeah. Restocking fee. Yeah. Significant financing component. All right. I will wait for your responses whether you have tried those questions. In the meantime, let me do illustration number 39. Illustration 39. Mark it as very important. Okay. VT Limited enters into a contract with a customer to sell equipment. Okay. The control of the equipment is transferred when the contract is signed. Okay. So control is transferred when the contract is signed, and control is transferred means what? Essentially, the customer will be able to direct how that asset has to be used. So today the control is transferred. The price stated in the contract, contract is 1 crore plus a 10% contractual rate of interest payable in 60 monthly installments of 2,12,470. Okay. So the price stated in the contract is 1 crore. So price stated is rupees 1 crore, and the contractual rate of interest. What is the contractual rate of interest? The rate of interest that is there in the contract, that is 10%. That is 10%. Payable in 60 monthly installments. So EMI is equal to rupees 2,12,470 for 60 months. For 60 months. Okay. Determine the discounting rate and the transaction price when the contractual discount rate reflects the rate in a separate financing transaction, number one, and the contractual discount rate does not reflect the rate in a separate financing transaction, that is 14%. Okay, so case A, your IRR is equal to the incremental borrowing rate. Case B, your incremental borrowing rate is 14%. Project IRR remains as 10%. This is the interpretation of the question. Okay. Thank you, Anjali, Purushottam, Ambika, for confirming. Yes, I hope those questions were you were able to do. Yes. Anyways, this one will solve most of the difficulties that are there. Okay. So I am having this case. Price today is 1 crore rupees. The contractual rate of interest is 10%. That is your what is your expectation? All right. The EMI is 2,12,470 for 60 months. For 60 months. So therefore, this is the data that is given. They have told you estimate the transaction price, do the accounting. Okay, so the answer is theoretical in the institute solution, but we will do a slightly practical approach. Answer as the same end of the day. Okay, so case A, the contractual rate represents the rate in a significant financing transaction. So I told you one thing, when we talk about significant financing component, which rate of interest has to be used by the seller? See, the seller is selling goods today, getting consideration after 12 months. Simple example. So therefore, in the selling price, there is a financing component. In the selling price, there is a financing component. So therefore, I have to essentially split. I have to split between the sales price as well as the financing component. So how do I do that? Which rate of interest do I do? I have two options. The first one is internal rate of return. That is the rate of return that is similar to what we have studied in lease, equating the minimum lease, the fair value of the, equating the present value of the minimum lease payments with the fair value of the product. Okay, the fair value of the asset. That was what you studied. Same concept applies here for the IRR. For the IRR, in the lease, Ind AS 116, you would use the implicit rate of interest. That was the IRR. However, what Ind AS 115 tells us is, first approach will be what? First approach will be use the incremental borrowing rate. Ask the question, if this customer had to go to the bank and take a financing to acquire this asset, what would be the financing of that particular buyer. Now it would depend on many factors. It would depend on what is the tenure of financing he's seeking, number one. It would depend on what is his credit rating. If his credit rating is very good, probably the rate of interest will be lower. So therefore, it will depend on various factors. Okay, so all those factors will be considered in the incremental borrowing rate of the customer. You have to take that rate. You have to take that rate mandatory. If that rate is not available, like for example, that person is not eligible to get a credit, is not eligible to get a loan from the bank, then you can fall to the next option, that is your IRR. Then and only then you can fall to your next option, that is the IRR. Okay, so this is what is there. Now, case A, your IRR, the contractual rate 10% is equal to the rate of interest that is there in the transaction, the rate of interest that is there in a significant financing transaction. So your company perspective rate, that is the internal rate of return, is 10%. That customer's incremental borrowing rate is also 10%. So any difference between the rates? No difference. So naturally, my transaction price will remain 1 crore rupees because the rates of interest are the same. So automatically my cash flows will be equated. IRR is that rate which equates the present value of cash inflows to the present value of cash outflows. So my transaction price will be at this stage 1 crore rupees itself. If you are convinced by this, it is fine. Otherwise, what you can do? Otherwise, you can just do a simple calculation. Your interest is 10% per annum. Your interest is 10% per annum. Therefore, since the EMI is on a monthly basis, since the EMI is on an equal monthly basis, what you will have to calculate? The present value annuity on a monthly basis, the present value annuity on a monthly basis, the annuity factor on a monthly basis. So you will have to calculate present value annuity factor of 10% per annum on monthly basis, for how many months? For a period of 60 months. For a period of 60 months. What is this annuity factor going to be? How will you calculate that? That will be simple. 1 divided by 1 plus 10% is for the full year divided by 12. This is your rate for a period of 60 months. For a period of 60 months. This is the present value annuity factor. You have to discount it, take the addition for a period of 60 months. Okay, so this is a slightly long calculation, but if you do this calculation, would you like to try this calculation, boys and girls? Present value annuity factor for a monthly transaction, monthly EMI taken to 60 months. Okay, can you do it for me? Yes. What will be my annuity factor? What will be my annuity factor? Do you like to try? Anyone? Anyone wants to try, boys and girls? For the first month, it will be 1 divided by 1.008333333. Then the next month will be 1 divided by, first month it will be 1 divided by 1.0083333 plus 1.0083333 the whole squared, like that for each month. Okay, you have to do it 60 times. Do you want to try it? It is basically a geometric progression. Okay, so if you do this, the present value comes to, the present value monthly factor, the annuity comes to, is equal to, this I have already calculated. Okay, so 47.065 369. You don't get a question of this type in the exam. Okay, this is for just making you understand your concepts. This is for just making you to understand your concepts. Okay, so this is the value of the present, the annuity 47.065. Now this, when you multiply with the EMI, multiply with EMI of rupees 2,12,470. How much you get when you multiply 47.065 369,023,752 into 2,12,470. 47.065 369,023,752 into 2,12,470. Yes, you will get rupees 1 crore. You will get rupees 1 crore. Correct, Ambika. Good answer. 47.06. That when you multiply, you have to get 1 crore. It is like moving in circles. Okay, it is like moving in circles. So your present value factor is 47 point something 06536. Okay, so when you multiply with 2,12,000, you will get 1 crore. So therefore, this rate means when your IRR equals IBR, the transaction price will remain 1 crore. So what is the entry that you will pass? What is the entry that you will pass? The transaction price in this case is 1 crore because IRR equals the borrowing rate. So when you make the sale, the entry will be debtors account debit to revenue. Debtors account debit to revenue. This comes to how much? 1 crore because the transaction price is 1 crore. The transaction price is 1 crore. All right, good. Yes, so yeah, that is 99,99,000 something. It is almost 1 crore, Ambika. Okay, so this is debtors account debit to revenue, and this is not collected immediately. So what will happen now? You treat this as a financing component, and every month compute the interest, then the payment, the interest and then the payment. This is nothing but the Ind AS 109 accounting that you normally do. Okay, so your second entry will be, your second journal entry will be what? My second entry will be debtors account debit to finance income. I'm going to get this money after 60 months. So how will I calculate? Rupees 1 crore. Rate of interest is 10%. This is for each month. So into 1 by 12. So this comes to how much? 83,333. 83,333. This is your finance income that you will record every month. And at the end of each month, you will get the money from the debtors. So the entry will be bank account debit to debtors. How much you will get? 2,12,470. 2,12,470. So exact Ind AS 109 accounting will be followed. Exact Ind AS 109 accounting will be followed. Is it okay? Have you understood this? Yes. Have you understood? Any doubts in case A? Purushottam, Anjali. Any doubts in case A? Okay. No answers. I assume that there is no doubt. A simple case. Okay. Why did I rub this out? Should not have. Okay. Now, the next case. Okay. The next scenario, case A is done. We got the accounting. Case B, you are giving the contracted finance at 10%. You are financing thinking that 10% is the rate of interest. But what the standard says, wait a minute. You cannot use your financing rate if the entity has or if the customer has its own borrowing rate. So in this case, you are given that borrowing rate to be 14%. You are given that borrowing rate to be 14%. So what you will do, you will calculate the present value annuity factor on a monthly basis of 14% for a period of 60 months. Did you understand? You will calculate the present value annuity factor on a monthly basis of 14%. Of which rate? Of 14%. For how long? For a period of 60 months. For a period of 60 months. So quick, get me this answer. Present value annuity factor on monthly basis of 14% for 60 months. Similar calculation to what you did previously. Only thing is, instead of 10%, you have to take the rate as 14%. You have to take the rate as 14%. So it will be 1 divided by 1 plus 0.14 divided by 12. This is the annuity that you will do 60 times. This is the annuity that you will do 60 times. Okay. Yes. All right. Calculate this PVAF. How much does it come to? Yes, thank you, Anjali, for confirming. What is your annuity factor? Any answers, Ambika, Anjali, Purushottam, any others who are there? Last class, I remember Karthik was there. Kaustubh was there long time ago. Kirtana was there. Yes. Annuity factor of 14% on a monthly basis for 60 months. What will be your annuity factor? $42.977. That's the right answer, Ambika. Okay, so your present value is annuity factor is 42.977016470 764. This is your present value annuity factor. Well done. So your PVAF on a monthly basis of the incremental borrowing rate of 14% for a period of 60 months is 42.977, 42.977016, so on and so forth. So now what you will do, your transaction price will be 2,12,470 into 42.977, whatever it is. Okay, so 42.977016470 multiplied by 2,12,470. That comes to how much? 91,31,327. 91,31,327. 91,31,327. Okay. Okay, sir, in case of EMIs, the payment will be made on the beginning of every month, so that we have to calculate the present value of annuities due. Purushottam, it is correct. Your understanding is fine. But in this case, it is paid in 60 months EMI. It is assumed that it will be paid at the end of each month. It is assumed that it will be paid at the end of each month. Okay, no down payment. End of each month it will be done. So this is how you will do the calculation. But yes, if you assume, yes. So Ambika has given the answer. I hope others are following. Yes, 91, 31, 327. Now look at the change. When I had IRR equals to IBR of 10%, my transaction price was 1 crore. My transaction price was 1 crore. However, in this case, because my IRR cannot be taken, preference will be given to the IBR, I will be reducing my transaction price. I will be reducing my transaction price. Why? Because now the financing component is larger. I am financing somebody at the rate of 14%, his rate of interest, not my IRR. What is his rate of interest? So 91, 31, 327 becomes my transaction price. And the balance amount that you will receive, 2,12,470 multiplied by 60 minus 91, 31, 327, that represents your finance income that will be apportioned over a period of 60 months. That will be apportioned over a period of 60 months. All right. So in this case, the second entry will be debtors account debit to finance income 91, 31, 327 multiplied by 14% into 1 by 12. 327 into 0.14 divided by 12. So 1,06,532. 106,532. And the payment entry will anyways be the same. 2,12,470. Then it is just Ind AS 109 accounting. Then thereafter it is just Ind AS 109 accounting. Okay. It is Ind AS 109 accounting. So now I hope you can understand the concept of no cost EMI is actually misleading. The concept of no cost EMI is actually misleading. There are various ways in which a no cost EMI transaction is done. It could either be done by giving a discount to the customers who are paying upfront, number one, or telling them that we give you a cashback. That is the second instance. Or in the third case, we will be charging a processing fee if you go for the EMI option. All these are just indications that we will be charging the interest. Even if you look at the transaction saying that, sir, there are no processing fees, nothing is there. You are going to pay 1,50,000 today also and 1,50,000 over the EMI tenure also, which will be 24 months. For example, one is customer will not agree to this, okay, because the customer who is paying upfront will definitely demand some benefit. Okay, naito he will say, what is the point in buying and paying today itself? Everyone will go for a 2-month EMI or a 2-year EMI. So these type of transactions will not happen. But even suppose they happen, suppose the possibility is highly remote, next to impossible, suppose they happen, even then there will be a financing component. You have to use the incremental borrowing rate of the customer. You will have to use the incremental borrowing rate of the customer. Acha, there are some transactions where you are getting the same benefits, but the EMI tenure is less than 12 months. Okay, 6-month EMI, 9-month EMI. Okay, so those are short-term payments. What did I say? The rebuttable presumption is financing exists if the time gap between satisfying the performance obligation and receiving the consideration is more than 12 months. In the case of EMIs of a 6-monthly tenure or a 9-monthly tenure, it is within the 12-month gap that is envisaged by the standard. So at that point of time, there is no financing really. It is just a deferment of your payments. You are not financing. It is like saying you are giving post-dated checks for 6 months. It is like saying you are giving post-dated checks for 6 months. There is no financing element. Like how in Ind AS 116 you had the option of treating short-term arrangements less than 12 months as an operating lease. The same thing applies here. You are deferring, but for a period less than 12 months, it is fine. It is a normal transaction. There is no financing component involved. Okay. All right. Have you understood the financing question in detail? Have you understood the financing question in detail? The institute's problem, they have given this as 91,31,346. Okay, that small difference of 15-20 rupees is due to rounding off, but otherwise it is the same answer. Okay. Otherwise it is the same answer. Okay, so I hope friends you have understood this. Yes. Sir, does financing move only from seller to the buyer, or can it move opposite way? That is from buyer to the seller. Answer is it can. Like for example, in a construction contract, there are two things in a construction contract. Okay, first thing is payments made on a progressive basis. Payments made on a progressive basis. Suppose you have booked a flat by a real estate developer and you make the payment after you enter into an agreement to sell. They give slabs. Okay, like the foundation is done, you pay 10%. The first slab is done, you pay 20%, 25%. Like that, they give the slabs. And at the time of possession, you have to pay the balance 10%. Now, this is not a financing transaction. This is a highly capital intensive project. You cannot expect the builder to get the borrowing and do the project by himself. He will need the money from the buyer also. So therefore, this is a capital intensive project. This is the industry norm to collect it in the normal course of business. Okay, so there is no financing component involved in such deals. However, let us take the case of a customer who knows of a project that a builder is going to start. He gives the money upfront. He says, your units, you are saying you will price it at 2 crore rupees. I will give you 1 crore 75 lakhs. Whenever you do the agreement, do the possession and send it, deliver the flat to me, my final consideration is 1 crore 75 lakhs. So therefore, who is financing whom here? The customer is financing the seller. So in this case, the financing component will result in an interest expense for the entity. That is the entity in whose books we are recognizing the revenue. The entity in whose books we are recognizing the revenue. So our next question is going to be based on this concept. Okay, it's going to be based on this concept. Okay, I think I had not told you to do this. I don't remember. Question number 40. ST Limited enters into a contract with a customer to sell an asset. Control of the asset will transfer to the customer in 2 years. That is, the performance obligation will be satisfied at a point in time. In step number 5, we will study what is that performance obligation satisfied over time or performance obligation satisfied at a point in time. The contract includes 2 alternative payment options. Payment of 5,000 in 2 years when the customer obtains control of the asset, or payment of 4,000 when the contract is signed. The customer elects to pay rupees 4,000 when the contract is signed. Okay, so now look at it. If only the first option was there, payment of 5,000 in 2 years when the customer obtains control of the asset. This is like saying the developer in our example of 2 crore and 1 crore 75 lakhs tells the customer, look, I will not accept 1.75 crores. You have to enter into an agreement to sell. Only then I will collect 2 crore rupees. There is no option of receiving the money earlier from the customer. So this point of time, if only option 1 was available, does it mean there is a financing component? Answer is no. You are paying as the project progresses. You are paying as the project progresses. So if only option 1 was there, there is no financing component. But because option 2 is also there in our example, because the builder also has given the customer an option to pay upfront and he is accepting the offer to pay 1.75 crores, because the second option exists, there is a financing component in the first option. There is a financing component in the first option. What is the second option saying? Payment of 4,000 rupees when the contract is signed. The customer elects to pay rupees 4,000 when the contract is signed. It is like saying customer is paying 1.75 crores to the builder. If this option is there and he chooses it, there is a 25 lakh financing component, 2 crore normal price minus 1.75 crores. There is a 25 lakh financing component. Who is financing whom? The customer is financing the customer is financing the seller. The customer is financing the seller. ST Limited concludes that the contract contains a significant financing component because of the length of time between when the customer pays for the asset and when the entity transfers the asset to the customer, as well as the prevailing interest rates in the market. The interest rate implicit in the transaction is 11.8%. This is my IRR. This is my IRR, which is the interest rate necessary to make the two alternative payment options economically equivalent. Which option? Option to pay now or option to pay after over the period of 2 years. When you equate both of them, to performance consideration today is 4,000. Consideration over 2 years is 5,000. When you equate both of them, the IRR becomes 11.8%. However, the entity determines that the rate that should be used in adjusting the promised consideration, is 6%, which is the entity's incremental borrowing rate. Now, who is borrowing the money? The entity is borrowing the money. It will be a cost for the entity. It will be a cost for the entity. So, will you take 11.8 or 6? And the answer is you will take 6%. The answer is you will take 6%. You will not take 11.8 because the standard gives preference to incremental borrowing rate over the internal rate of return or the implicit rate of interest. Pass the journal entries showing how the entity would account for the significant financing component. Acha, when I get the money today of 4,000 rupees, is the control transferred? Is the control transferred? And the answer is no, it is not transferred. Yes, the control will be transferred after 2 years. That means at a point in time. So today when I get the money, it is nothing but advance received. It is nothing but advance received, which is like a contract liability, So the entry that will be passed today is bank account debit. Today I get 4,000 to, I am not selling today. I will be selling after year 1. So to contract liability 4,000. This goes and sits as your contract liability. This goes and sits as your contract liability. Now, end of year 1. Okay, end of year 1. Year 1 end. Interest will accrue on that. So bank account debit to contract. Sorry, not bank account debit. This is interest cost, interest expense debit to contract liability. Contract liability increases. Contract liability increases. Okay. This will be 4,000 multiplied by which rate will you use? Will you use 11.8 or will you use 6%? You will use 6%. You will use 6%. So this comes to 240. This comes to 240. Next, year 2 end, what you will do? Again, same entry. Interest expense account debit to contract liability. Now, this will be on which amount? 4,240. Compound interest, Ind AS 109 concept. 4,240 into 0.06. That comes to 254. That comes to 254. So your contract liability is 4,000 plus 240 plus 254. So that comes to 4,494. So when the asset is transferred, you book the revenue. Entry will be contract liability account debit to revenue. Contract liability account debit to revenue. 4,494. 4,494. Is it okay? Yes. Simple, straightforward accounting. Okay. So financing component, a significant financing component. We have covered all the problems. You have covered most of the problems. I have done two small problems here. But tell me, friends, all of you who are watching, have you understood all the problems relating to the financing component? Yes. If there is even one question in the homework questions also that I gave you to try, is there any question in that which you find it difficult? Then let me know. I will be happy to address it. Okay. If not, we will proceed further. Okay. Please let me know whether you have any doubts in those questions. It is a very important part. Since 8 to 10 questions are there, you can expect this in your exam. Okay. So financing component, significant financing component is very important. The word significant is important. Okay. The word significant is important. In case of construction sectors, suppose entity bills the revenue each purchase to purchase basis of raw materials that are used for projects in case of EPC contracts, but the customer pays us based on the percentage completion method on a monthly basis. How would we account for it and how to measure the time gap for performance and receipt of consideration? Please wait until step 5 comes. Please wait until step 5 comes, because step 5 deals with how to account for revenue. Okay. So Purushottam, your queries on the construction sector, please postpone your doubts till step 5 is over. Okay. All these queries that you have asked are there in step number 5, beautifully explained. Okay. So in step number 5, we will be answering all these type of queries. Okay. So until then, just park your doubts at one side. Okay. Because you will be having recognition of revenue over time and at a point in time. So very important concept. I do not want to discuss those concepts at this stage. Okay. All right. So just park it separately. I will be dealing with them. That point, you yourself will understand your doubts. You yourself will understand your doubts. Okay. Since you are, I think, continuously exposed to the construction sector in the course of your articleship, you have this kind of doubts. Nevertheless, we will be doing it in step number 5. Okay. So this is done. Now, let us move on to the next. Significant financing component is closed. We have done now in determination of transaction price. Number 1, determination of transaction price, we discussed variable consideration, we discussed sale or return, we discussed warranties, restocking fees, and significant financing component. 5 things we have discussed. 2 more things are left. One is a non-cash consideration. The other is payments made to customers. Non-cash consideration and payments made to customers. And there is a small subpart of non-cash consideration, that is customer provided goods or services. Okay, customer provided goods or services. Now, non-cash consideration. Non-cash consideration. What do you mean by non-cash consideration? Very simple, sir. It is a barter transaction. It is a barter transaction. But remember, when we talk about barter, important thing, go to the first step that we did, identifying the contract. There must be a commercial substance. There must be a commercial substance. I gave you the example of those vehicles being transferred from one showroom to another just to jack up the revenues. those are not items of a commercial substance. Okay, so when you do a barter transaction, the cash flows before such transaction and the cash flows after such transaction should be significantly affected, if it is affected, then yes, there is commercial substance. If no, there is no commercial substance. Okay, so under the barter transaction, when we are discussing determination of transaction price, we come from where? We come from the step number 1. The contract is there, it meets commercial consideration, we have identified the obligation, and now we are on determining the transaction price. Okay, so now barter. You remember we used to have these provisions even in the case of Ind AS 30, Ind AS 16, Ind AS 38 that dealt with intangible assets, Ind AS 40 that dealt with investment property. What was there? In the case a property, plant and equipment or intangible asset or an item of investment property is acquired other than cash, that means your consideration is received in a manner other than cash. Okay, that means what? In the form of an asset. Then how would you measure that asset? You would measure it based on fair value of asset given up, unless the fair value of the asset received is more clearly evident. You remember this? We used to do this kind of thing in Ind AS 16, 40 as well as 38. Measure the fair value of asset given up unless the fair value of the asset received is most clearly reliable, okay, or most clearly evident. These were the exact words which were used in those standards. Ind AS 115 departs from this. Ind AS 115 departs from this. Ind AS 115 is a revenue standard. It is not an asset standard. It is a revenue standard. It is saying you have to recognize revenue, and revenue must be recognized based on what you expect to receive. Based on what you expect to receive. Therefore, the first preference will be based on the fair value of the consideration that you will receive, based on the fair value of the assets that you receive. So the first important thing is this revenue which you receive as a non-cash consideration will be based on fair value of assets received. Fair value of assets received on the expected value of consideration to be received. There it was fair value of asset given up, except that you can use the fair value of asset received if that is more clearly evident. But here the standard says nothing doing. First preference will be fair value of assets received. And if this is not determinable, the word used is not determinable. It is not saying less reliable, more reliable, whatever it is. It is saying if this consideration is not determinable, only then you move to the next one, that is fair value of assets given up. Fair value of assets given up. So the criteria is not existence of reliability. There may be a consideration, there may be a fair value of the assets that can be determined. It may not be very reliable, but it can be determined. Even then you have to use that. Okay, even then you have to use that value. You cannot say it is the fair value of assets given up since it is more clearly evident. That is not what you can use under Ind AS 115. You have to use the words fair value of assets received. If this cannot be determined, then and only then you have to use fair value of assets given up. Fair value of assets given up. Okay, so there may be certain instances when your consideration that you get could be a financial instrument, like for example you may get an equity share, or you may get some bonds, or whatever it is. Now these items would be subjected to a fair value measurement. So on the date of the transaction, my friends, when you receive it, there is a particular fair value of that share. Now, once you got that share, you have to fair value it. Either you take it to OCI or you take it to P&L. The equity share has to be fair value. Now, the movement in those fair values will it affect my revenue? And the answer is no. Once you got the equity share as a consideration for your performance obligations, thereafter the movement in those fair values is not pursuant to Ind AS 115, it is pursuant to Ind AS 109. So therefore any movement in those fair values cannot be taken to be affecting my revenue. I will not go back in time and restate my revenues. Likewise, if you get some parcel of land or whatever it is, and you follow the revaluation model, the revaluation model price of the land has increased. So therefore, what do? Therefore, will you increase your revenue because the fair value of land has increased? Answer is no. The movement in fair value of that land you have estimated pursuant to the requirements of Ind AS 16. You cannot take it as a revenue obligation right now. Do you want to say that when the fair value is measured, are you transferring any additional obligation to him? You are not. You have already transferred the performance obligation when you got the consideration. So therefore, when you got the consideration, when you transferred it, you have already fulfilled your obligation. On that date fair value, the revenue has already been recognized. Any subsequent movements in those fair values, you cannot attribute it to the revenue already recognized. It will be pursuant to those standards. It will be pursuant to those standards. Is it okay? Yes. So this is what is the meaning of non-cash consideration. Simple concept. Fair value of assets received. Why is it so? Because look at the definition of transaction price. Transaction price is the fair value, is the value of the consideration that you expect to receive towards satisfaction of a performance obligation. So we have to look at the fair value of the assets which are received only if it cannot be determined, and that is a very remote possibility. But if it cannot be determined, only then you look at the fair value of assets given up. Okay, so with this background, let us look at some questions. I think I have put some questions. I have few people have done this. Yes. Okay. An entity enters into a contract with a customer to provide a weekly service for 1 year. In a year, there are 52 weeks. So 52 times the services will be provided. Okay. The contract is signed on 1st April X1 and work begins immediately. The entity concludes that the service is a single performance obligation. This is in the nature of the same pattern of transfer, right? So they have said it is a single performance obligation. This is because the entity is providing a series of distinct services that are substantially the same and have the same pattern of transfer. The services transferred to the customer over time and use the same method to measure the progress. That is a time-based measure of progress. In exchange for the service, the customer promises its 100 equity shares per week. That means today when I do the service of 1 week gets over, I will get 100 equity shares in the customer. Second day I will get, second week is done, I will get another 100 equity shares, so on and so forth. The terms in the contract require that the shares must be paid upon the successful completion of each week of service. How should the entity decide the transaction price? Simple. You are getting the transaction price 52 times. You are getting the transaction 52 times. 1 week you have worked, you will bill the customer, he will pay you 100 shares. So the fair value prevailing as on that day, the fair value prevailing as on that day. Let us assume week 1 you worked. On that day, on the day your work is done, you gave the bill. Let us assume that the fair value of the equity share was, for our understanding, let us assume it was 200 rupees. So you will book your revenue as investment in equity shares of the entity of the customer account debit to a revenue at the rate of 200. Now, in the next week when you performed, the fair value will remain the same of the equity share. Answer is no, it may have moved. It would now be 205, for example. So week 2's revenue will be recognized as 205. Will you go back in time and restate the revenue of 200? And the answer is no. You will restate the equity because that is pursuant to Ind AS 109. but you will not go back in time and restate the revenue. You will not go back in time and restate the revenue. Is it okay? So any subsequent changes in fair value, you cannot take it to your revenue. It will be pursuant to the other standards. It will be pursuant to the other standards. Is it okay? Did you follow? Yes. Next one. Next one. Yeah. Illustration 49. RT Limited enters into a contract to build an office building for AT Limited over an 18-month period. AT agrees to pay the consideration to pay the construction entity 350 crores for the project. RT Limited will receive a bonus of 10 lakh equity shares of AT Limited if it completes the construction of the office building within 1 year. If it completes the construction within 1 year, assume the fair value of rupees 100 at contract inception. Determine the transaction price. Okay. So, in this case, I am talking about illustration 49. Okay. Transaction price is having two components. One is fixed, the other is variable. 350 crores. Okay. Now stop share. Yeah. Fixed is 300 crores. Variable consideration is also there in the manner that if I complete within 1 year, I will be given 10 lakh equity shares. So this is a variable consideration. This is a variable consideration. What you will do with variable consideration? Two things. Subjected to constraints. If it is subjected to constraints, will you include in transaction price? No. Exclude from transaction price. Exclude from transaction price. And if it is not subjected to constraint, the example of L&T completing the project, not subjected to constraints, what you will do? You will include in transaction price. You will include in transaction price at inception. So at rupees 100 per share for 10 lakh shares. For 10 lakh shares. So 10 lakh into 100, that gives you how much? 10 crores. That gives you 10 crores. So what will be your transaction price if this is not subjected to constraint? 350 crores fixed. This will be included and 10 crores. So your transaction price will be 360 crores. Your transaction price will be 360 crores. Okay. Have you understood non-cash consideration? Yes. Clear? All clear, no? Okay. So it's an easy concept. Just have two more easy concepts and that will complete our step 3. Then we have step 4 and step 5. I hope it's all clear. Yes. Now, next question. Again, newly introduced, but principles remain the same. Principles remain the same. Yeah. Illustration 50. Production company Y sells a television show to television company X. The consideration under the arrangement is a fixed amount of rupees 1000 and 100 advertising slots. Okay. Y determines that the standalone selling price of the show would be 1500. Based on market rates, Y determines that the fair value of the advertising slots is rupees 600. Determine the transaction price. Determine the transaction price. So now, what does it mean? I am a television producing company. I have given a television show to X. The consideration will be 1000 rupees plus advertising slots. So that plus advertising slots, you will go for fair value. The standard has told non-cash consideration will be fair value based. So you have to take which rate? 600. However, if the 600 could not be determined, you will take which rate? You will take 1500. So the fair value is given, it will be 1600, 1000 plus 600, and the fair value is not given. The fair value is not determinable. Then what it will be? The standalone selling price, that is 1500. That is 1500. Okay. All right. The transaction price would be 1500. Clear? All clear? Yes. All well. So now let us move on to the next concept, which is a bifurcation of this, or what I can say, a customer provided goods or services, which is, like a byproduct of this discussion, All clear? Can we proceed further? Yes. Okay. Now, a byproduct of this discussion, customer provided goods and or services. Okay. So let us understand this with the help of an example. Let us assume that you are Mercedes, okay, the car company, and on the other side, there is this entity MRF, the tire company. Okay, so what MRF wants is, MRF wants to purchase a car for its CEO, managing directors, all these people. It wants to purchase a Mercedes car. So Mercedes will be the seller, MRF will be the buyer. So the selling price, selling cars. Okay, selling cars. Okay, so this is the agreement. What MRF has said is, look, you anyways procure tires from us to fit. Okay, this is just a hypothetical example. Don't draw any conclusions. Does it really do Mercedes? I say don't draw such conclusions. Just a hypothetical example. You anyways have to fit in the tires in the cars, and we are a tire manufacturing company. We know the best quality of tires. So what we will do is, we will be paying you 48 lakhs per vehicle, 48 lakhs per vehicle, plus four tires to be fitted, plus one spare tire. Okay, in case my tires get punctured or whatever it is. So every car will have 5 tires in it, 4 that are running and 1 that is the spare tire. So therefore, MRF says, I will pay you 48 lakhs plus the tires, So now the question arises, what should be the revenue that Mercedes should book? Simple concept. We have just now discussed non-cash consideration. In which it was said, any consideration that is received other than cash, you will have to take the fair value of that consideration. So therefore, 48 lakhs plus if the fair value of this is 2 lakhs, for example, then it will come to rupees 50 lakhs. So therefore, Mercedes will recognize revenue as 50 lakhs. The standard does not say consideration or the transaction price must be received in cash. It could be received in cash as well as in kind or totally in kind. In which case the standard says if there is an element of consideration received other than cash, you will have to measure it at fair value. Only if fair value is not determinable, you will have to measure it at the fair value of the asset that is given up, at the fair value of the asset that is given up. Fair enough? Yes. Clear? Acha. Let us assume that the tires that MRF is giving, is a general quality tires whose fair value is 2 lakh rupees. Mercedes gets those tires, but it does not use those tires in the car that is transferred to MRF. Did you understand now? MRF gave some tires. Mercedes got 48 lakhs plus those tires. But in the car that Mercedes delivers to MRF, those tires are not fitted. Doesn't matter. You do not have to fit those tires in that car. You got it. That is end of the story. Whether you fit it in in the tires to be given to MRF Limited, or you put it in some other car, or you just keep it as it is. Okay, whatever be the thing, it is your choice. The fact that you have received those tires must ensure that you must include it in the transaction price. You must include it in the transaction price. You cannot ignore it. So whether these customer provided goods are included or not included in the final product, it makes no difference. It makes no difference. You have to include it as a part of the transaction price, as a part of the transaction price. Is it okay? Yes. Is it fine? Another example of this could be you purchase your phones on, suppose you want to buy an iPhone, for example, okay, a pricey iPhone, 1 lakh, whatever the rate is today, I don't know, 1 lakh or 1,12,000, whatever it is, you want to buy. And there is an exchange offer going on. You have an iPhone that is there, a previous model, you want to buy the new iPhone. So what you do, look, I do not want two phones. In any case, Apple gives a single SIM phone. So I do not need this phone. So what you will do, you will go to the Apple reseller and tell, look, you have an exchange offer that is going on. So please tell me what will be the value of this phone. So let us assume that the new phone has a value of 1 lakh rupees and the exchange price of your phone is say 5,000 rupees, So therefore, what you will pay is 95,000. So now you tell me, you will be able to understand this clearly now. Does Apple recognize revenue on the new phone as 95,000? And the answer is no, it cannot. What the customer is giving is 95,000 cash plus a phone whose fair value is 5,000, plus a phone whose fair value is 5,000. So therefore, the customer is ultimately giving 1 lakh rupees only. It is just in two different forms. 95,000 is by way of cash, money, and 5,000 is by way of a phone. So therefore, revenue will be still recognized at 1 lakh rupees only. Revenue will still be recognized as 1 lakh rupees only. Important thing is consideration. How should it be discharged is not specified. How should it be discharged is not specified. It can be in cash also. It can be in kind also. These are the principles relating to non-cash consideration. Take cash plus the fair value of the assets which are received. Cash plus the fair value of the assets which are received. Okay. This is a byproduct of non-cash consideration entirely. Okay. So customer provided goods and or services. Okay. All right. So now, yes. Sir, customer provide the goods. Yes, Ambika, I have just now discussed. Yes, I think you are also confirming the same. Yes, MRF giving tires is nothing but providing the goods. You giving the iPhone is nothing but you giving goods plus 95,000. So you add both of them. Don't just take the cash consideration and recognize the revenue. Revenue can be in cash. Revenue can be in kind also. Okay. So this is your non-cash, customer provided goods and or services. Okay. Yeah. Illustration 51. MS Limited is a manufacturer of cars. It has a supplier of steering systems, SK Limited. MS Limited places an order of 10,000 steering systems on SK Limited. Okay, so you are having SK Limited and MS Limited. Okay, so SK is the one who is supplying the steering systems. So therefore, there will be a sale of steering systems. Steering systems. Okay. MS places an order of 10,000 steering system, agreeing to pay rupees 25,000 per steering system. So at the rate of rupees 25,000. At the rate of rupees 25,000. Agrees to pay 25,000. So MS will pay how much? 25,000 per system. 25,000 per system. And what else is given? What else is given? And contributes tooling to be used in SK's production process. The tooling has a fair value of 2 crores at contract inception. Plus tooling. Plus tooling. Okay. So SK is giving 25,000 per steering system plus the tooling. Plus the tooling. The tooling has a fair value of 2 crores at contract inception. SK determines that each steering system represents a single performance obligation and that the control of the steering system transfers to MS upon delivery. SK may use the tooling for other projects and determines that it obtains control of the tooling. Determine the transaction price. Simple. Whether they use the tooling only for MS Limited or for somebody else, it doesn't really matter. What matters is you are giving cash of 25,000 per steering system. 25,000 per system means you are placing an order for how many systems? You are placing an order for 10,000 systems. So that means how much? You have told you will be paying 25 crores in cash, plus you are giving a tooling system of 2 crores, plus you are giving a tooling system of 2 crores. So you are giving in totality how much? Rupees 27 crores. In totality, you are giving rupees 27 crores, and rupees 27 crores means per unit value will be how much? Per unit value will be rupees 27,000. Per unit value will be rupees 27,000. Is it okay? Yes. Is it fine? 27,000. Acha. Sir, suppose the tooling comes at the end. Suppose the tooling comes at the end of the contract. You are already starting to supply 10,000 steering, 500 steering systems, so on and so forth. So for the initial supplies that you have done, in respect of which tooling has not yet come, tooling will come later. Do I have to recognize revenue at 25,000 or 27,000? Answer is you will recognize at 27,000 only. It is just a matter of time when the tooling reaches you. Okay, so as per the contract, it has to come to you. So therefore, you will recognize the revenue at 27, not at 25,000, not at 25,000. Is it okay? Yes. All clear? Guys. All clear so far? If it is all clear, let me move on to the next step. Let me move on to the next and the last item of step number 3, that is third point of today's discussion. Consideration payable to customer. Consideration payable to customer. So we have covered variable consideration. We have covered warranties. We have covered sale or return, restocking fees, and today a significant financing component. and the one before this, non-cash consideration, customer provided goods, a byproduct of that, and the last item is consideration payable to customer. Consideration payable to customer. Okay, very, very important, a unique transaction. Okay, so it is very, very important for us to understand. Up till now, is it all clear? Yes, till now, have you understood? Have you understood until now? Any doubts, queries, difficulties? I'll wait for about 10 seconds. Okay, so no query. So let us proceed further. Okay, now let us understand this with the help of an example. Let us understand this with the help of examples. Okay, so now you are PepsiCo, that is manufacturing Lays. That is manufacturing Lays, or why do I take Lays? Let me take the example of soft drinks. Like, what are their beverages? Pepsi. I think also, which is that one? Mirinda. All these type of soft beverages are being provided. Okay. Yes, Ambika, please give your suggestion. Okay, I will be going through it. Okay, please give your suggestion. I'll go through it. Okay. Give your suggestion. Pepsi, Mirinda, whatever it is. Okay. So now your soft drinks are given to a retailer. Okay. Why retailer? Let us take Pizza Hut. Okay. Pizza Hut is going to enter into an agreement. Okay. What it says, PepsiCo will give its soft drinks to Pizza Hut to retail. That means whenever PepsiCo sells to Pizza Hut, Pizza Hut will give the consideration. Pizza Hut will give the consideration. So what PepsiCo will do? PepsiCo will give beverages. PepsiCo will give beverages at rupees 40 per unit. At rupees 40 per unit. At rupees 40 per unit. Okay. This is the consideration. So Pizza Hut, for every beverage that is sold, that is given to it, will pay 40 rupees per unit. This is the normal transaction. This is the normal transaction. However, what PepsiCo does is it sends the big bottles, 1.5 liter bottles of Pepsi. It sells. Okay, it sends 1.5 liter bottles of Pepsi, Mirinda, etc. So what the Pizza Hut says, look, we are ready to keep your goods and sell it to the customers, but it's a 1.5 liter big bottles. We don't have the capacity to do that. Okay, you give us small bottles or you give us cans, it is fine. But PepsiCo tells, look, I cannot give you the cans. Okay, because it is not going to work out feasible. I will give you the bulk 1.5 liter. You pour it for the customers. Okay, so what PepsiCo says, you have to make the arrangement. So Pizza Hut says, fine, I will buy a fridge, a refrigerator that meets the size of your bottles. So Pizza Hut says, I will buy a refrigerator, but the cost of the refrigerator plus the storage charges, you will have to pay to me. Okay, so what it tells PepsiCo, look, I will buy a fridge, but buying the fridge plus, chilling your beverages, all those costs you have to pay to me. I will install a separate electric meter only for the fridge. Whatever is the electricity bill, you will be paying, because I am promoting your sales. and I am making additional space for you. So you will have to promote, you will have to make payment for that. So what Pizza Hut tells? Pizza Hut tells, look, what Pizza Hut tells PepsiCo is, see, I will buy a refrigerator. Okay, so refrigerator as well as storage cost I will incur. PepsiCo has to refund that or reimburse that, make a payment to Pizza Hut. PepsiCo knows that costs are definitely involved in storing its beverages. PepsiCo also knows that Pizza Hut is a popular brand. So what PepsiCo will do, it looks at Pizza Hut's outlets across the country and it says, we are entering into a good tie-up. We are entering into a good tie-up. So therefore, PepsiCo agrees to make the payment of the refrigerator and the storage costs to Pizza Hut. Okay, so there are two considerations which are flowing here. The first consideration is what? The first consideration is Pizza Hut, which is the entity that buys, is making payment to the seller. In other words, this is normal. This is normal. Why do I say normal? Yeah, when seller makes the payment, when seller sells the goods, customer makes the payment, that is normal. However, when customer is expecting a payment and seller makes a payment to the customer, this leg of the transaction is abnormal. I'm using the word abnormal just for us to understand. This is normal, this is abnormal. Okay. So why is this abnormal? Because normally it is the customer who pays the seller. The seller paying the customer is not the practice. So when you see such kind of arrangements, it is fraught with a degree of suspicion. It is fraught with a degree of suspicion. So the question arises, how should PepsiCo recognize its revenue? Should it recognize on gross basis and recognize a cost here, or should it recognize on a net basis? Have you understood the question? Should it go for grossing? Grossing up means what? Total sales as it is and costs. So you will have sales in your P&L and you will have these as costs. Or should it be net sales? Should it be net sales? Okay. This is what the question arises. This is what the question arises. Okay. So now, should I go for grossing up? Should I go for net? This is the question that arises. What you will say, which I also said once upon a time, sir, what is the effect whether I gross up or whether I do net sales? Effect is the same in the P&L. Profit does not change. Here also, if the grossing up revenue is 40 and the cost is 10, then my P&L will have a profit of 30. Here, if I do net, then also my profit is 30. So what is the impact? What is the impact? The impact is just that 40 minus 10, 30. This is involving inflating your revenue. This is involving inflating your revenue. And when it is inflating your revenue, naturally you are presenting growth prospects to your financial readers of financial statements. You are giving them the information that your revenue is on an upper trajectory. Your revenue is increasing. Whereas here, you are saying that my revenue performance is lower. My revenue performance is lower. Any entity will want to go for the grossing up. Any entity will want to go for the grossing up. Why would it want to go for the grossing up? Because it wants to present the picture that its sales are increasing. Okay. So therefore, Ind AS 115 felt the need to give guidance in this regard. And now, what is the guidance that is given? What is the guidance that is given? Very, very important. Please pay attention. The guidance tells us that if this leg of the transaction, if this leg, that means payment made to the customer, if this leg gives, distinct goods or services, distinct goods and or services, then what does it mean? If this gives distinct goods and services, then you do a grossing up. Then you do a grossing up, because it actually involves something that is actually being transferred to PepsiCo. It involves something that is actually being transferred to PepsiCo. For example, sir, give an example of distinct goods or services in this context. It means every Pizza Hut outlet has a dedicated storage space for Pepsi. It is visible, visibility is there to the customers, and the right on that storage space is only available to PepsiCo. The right on that storage space is available only to PepsiCo. PepsiCo can decide which drinks should be placed, how they should be placed to maximize the visibility. Ultimately, Pizza Hut is providing a visible marketing service to PepsiCo, a visible marketing service to PepsiCo. So when a customer enters the Pizza Hut store, he will see definitely the pizzas, but he will also see that there is a Pepsi fridge that is kept, which is serving the beverages that are manufactured by PepsiCo. So therefore, that service is a distinct one. That service is a distinct one. Which service? Providing visibility, giving right of preference to the PepsiCo company, giving right of preference to the PepsiCo company. It may go even one step further and say, look, we will enter into an exclusive contract with you. We will only sell beverages from PepsiCo. We will only sell beverages from PepsiCo, which is actually what is the case. So in this case, there is a distinct service that is being supplied, which is marketing plus exclusivity, which is priority as well as exclusivity, and because this is a distinct service, a distinct offering in the context of these two contracts, what will you do? You will treat them as distinct. You will follow grossing up. For example, if your revenue was 40 and the purchase, these costs are 10, you will show sales as 40, you will show the costs as 10. Why? Because both of them are distinct. Okay. And next one is net sales. Sir, when do I not gross up? When do I go for the net option? Simple case of opposites. If the goods and services are not distinct, let us assume that this is not Pizza Hut. Rather, this is what you can say, a grocery store, a simple grocery store. I don't know any brand as such, but a simple grocery store, which you have a departmental store. Now, you go to the departmental store, PepsiCo goes and says, you keep these bottles with you to sell to your customers. The grocery store says, look, we have Coca-Cola also. You are also coming now. We have other brands also. Okay. So we will buy a fridge for you, but we are not giving any right of exclusivity to you. We are not giving any priority to you. We are not booking any slot for you. So these type of things are known as slotting charges. Okay. Keep dedicated slots available for them so that they attract the customer's attention. The grocery store is saying, we are doing nothing of that sort. We are buying a fridge because yours is the additional stock. But in that fridge, your goods also may be there. Coca-Cola also may be there. There is no exclusivity between you. We are just buying and storing your goods. We are not giving you any visibility, preference, priority, exclusivity. So in this case, is there any distinct thing that is being transferred to PepsiCo? And the answer is no. There is no distinct goods or services. These are integrated obligations. See, if The grocery store has to sell the beverages. It has to store them. Yes or no? It would do the storing. It is a highly integrated activity. Remember the case of when we did identifying performance obligation, we saw what is my obligation when my obligation becomes distinct. There were three negative conditions that had to be satisfied. It is not part of a significant integration, not part of a customization or modification, not highly interrelated. In this case, the storage is essential to do the sale. So therefore, there is no distinct offering which is given. So therefore, it is one single performance obligation. You will go for the net approach. You will go for the net sales. You will go for the net sales. However, if the grocery store tells us, look, we keep Coca-Cola also, we keep Pepsi also, but what we will do is the moment the customer enters on the panel that faces the customer, we will keep your beverages so that your product gains priority, visibility, and therefore those stores, those slots, those racks are benchmarked only for you. When you give this kind of visibility, when you give this kind of items, when you give this type of service, it means you're offering something distinct. And when you're offering something distinct, what you will do? You will go for grossing up. You will go for grossing up. Is it okay? Did you understand? Yes. You know why this whole thing came into existence? Because you know what companies would do? They would go ahead and increase their revenues. How they would increase? They would go to this grocery store and tell, look, you store our products. We don't want any exclusivity, etc. The fact that you are storing it is sufficient for us. So therefore, you make a bill for us. You make a bill for us for storage charges, etc. And that those storage charges you can bill us at, let us assume, where it went, yeah, those storage charges you bill us at 50 rupees per unit. Okay, it was earlier 10, now you bill it to us at 50. The consideration that you will pay us, earlier it was 40, now it will be rupees 80 per unit. So look at the impact from the agreement between PepsiCo and grocery store. Earlier consideration for was 40, payment was 10. So net impact is 30. Yes. And here also it is now 80 and 50. It is now 80 and 50. So net impact is again 30. So what would companies do is they would enter into such artificial arrangements. They would enter into such artificial arrangements and increase the revenue fictitiously. Increase the revenue fictitiously. So therefore, the standard came into force and said, you cannot recognize on a gross basis. You can only do it on a net basis if your goods are not distinct. If your goods or services are not distinct, which are provided by the customer to the seller. Okay, customer to the seller, not distinct, net it off. Not distinct, net it off. Show 30 rupees as your revenue. Show 30 rupees as your revenue. Have you understood this? Have you understood this? Yes. The next part, Ambika, go ahead. You are saying 21st February, coming Sunday. Yes. What is it? Don't worry, you won't have my session. Okay. You won't see me again. It's been a long time, I understand. Okay. So today is the last live class that I'm having with you. Tomorrow will be the recorded session and it completes our discussion on Ind AS 115. The recorded session you can view at leisure. Okay. So I understand you guys are attending right from November every day morning. It is a bit strenuous on you. You people are doing morning session, evening sessions. You may be even going through the articleship grind. Okay. So therefore I understand. So this Sunday you won't have the session. Don't worry. Okay. So consideration payable to customer. Up till now, is it clear? Yes. There is one more important concept that I need to do, and then I can complete this. Okay. So Anjali, Ambika, Purushottam. So far, is it clear? Yes. So far, is it clear? I am waiting for your responses. Anjali, Ambika, clear? So when we talk about distinct goods or services, please refer the distinct that we discussed in the context of step number 2. In the context of step number 2. All clear till now? Yes. Quick. Others who are watching, you can also drop in your comments or queries. Okay. These guys have been constantly interacting with me. In fact, they have made me feel it is a live class that is going on. Okay, I'm so thankful to all of you for continuously interacting with me. I know it's difficult, but you have made me feel that yes, I am in a live session. All right, so I thank all of you for that, and for all your feedbacks which I have received on this. I thank you for them also. Okay. All clear till now? Yes. Can we proceed further? Okay. Okay. Now we go back to the next. We go back to the next case, which is important. And it is somewhat similar to what you have already studied. It is somewhat similar to what we have already studied. So please pay attention. We again get back to our scenario of PepsiCo and Pizza Hut. Okay, PepsiCo and Pizza Hut. So the exclusivity, etc., is a distinct service that is offered by Pizza Hut to PepsiCo. Now it can happen that the fair value is rupees 40, and here the fair value is rupees 10 per unit. Okay, fair value is 10 per unit. Okay. Oh, okay. All right. Okay, so rupees 10 per unit, rupees 40 per unit. Okay. The fair value of this transaction is like this. If PepsiCo sells beverages to Pizza Hut, Pizza Hut should pay 40 rupees. Pizza Hut should pay 40 rupees. Fair value. And for the storage, fridge cost, etc., they have arrived at a cumulative rate of 10 rupees per unit. They have arrived at a cumulative rate of rupees 10 per unit. So now PepsiCo wants to boost its revenue. PepsiCo wants to boost its revenue. So what it will tell Pizza Hut, look, you are giving me an exclusivity contract. You are giving me a distinct service. So therefore, let us enter into this arrangement. What arrangement? Look, you pay me rupees 100 extra. That means what? For one beverage that you purchase, you give me 140 rupees. Pizza Hut will say, why should I give you 140? Your beverage is only 40 rupees. Why do you want 100 rupees extra? PepsiCo will say, wait. And on the purchase leg, I will give you rupees 110. I will give you rupees 110. Okay. That means what? When PepsiCo sells, it will collect 140. When Pizza Hut collects the storage charges, etc., it will PepsiCo will pay 110. Artificially, they have jacked up the prices. Artificially, they have increased the prices. PepsiCo's revenue has gone up. Now, the loophole that was there, distinct goods and or services are provided, and the standard says you have to recognize without netting off gross. So PepsiCo says, well, I have a distinct goods or services, so I can do a grossing up. So I will recognize revenue at 140 and my expenses at 110, and the standard says, wait. We know that creative accountants like the ones in PepsiCo are there. Okay, I have nothing against the company. Okay, let me just be frank. This is just an example. Okay, this is just an example. So don't think that I know anything about the company. This is just an example. Just an example. Okay, so the creative accountants in PepsiCo are there. Ind AS 115 tells us Ind AS 115 tells us, okay, that Ind AS 115 tells us that, look, we know that you will do something like this. We know that you will do something exactly like this. And therefore, the standard has put in a caveat. The standard has put in a caveat. Sir, what is the caveat? The caveat is, if the consideration for the distinct goods and or services exceeds the fair value, if the consideration exceeds the fair value, then what is the amount in excess of the fair value will be deducted from the revenue. What is the consideration in excess of the fair value will be deducted from the revenue. So therefore, what the standard has said, are you providing distinct goods and services? Answer is yes. Is your consideration, what is the fair value of your consideration? 10 rupees. But you have billed it at what? You have billed it at 110. Because you have billed it at 110, because you have billed it at 110, you have billed additional 100 rupees above the fair value. And because you have billed additional 100 rupees, that 100 rupees will be deducted from the revenue. Revenue will come at 40 and the remainder will be treated as a purchase. The remainder 10 rupees will be treated as purchase. Ultimately, you fall back to revenue at 40 and purchase of 10. So therefore, the standard says, if the transaction on the purchase leg, payments to customers, is made at fair value or below, fine, no problem. Take it to P&L as it is. Revenue is not getting inflated. However, if this transaction exceeds the fair value, if this transaction exceeds the fair value, the difference, the amount by which the consideration for the second leg exceeds the fair value, that excess amount will be deducted from the transaction price, will be deducted from the transaction price. In our example, excess is 100, you will deduct 100 from 140. So revenue will be at 40 and your second leg will have a purchase value of 10 rupees. This is how you will present. So this is the distinct goods or services above the fair value, and this is something that you have exactly studied in Ind AS 116, sale and leaseback transactions. Sale and leaseback concludes at a price above the fair value, you know the treatment. If it concludes at or below the fair value, you know the treatment. Same treatment is there in Ind AS 115. Same treatment is there in Ind AS 115. Acha. Sir, 1 minute. If this is not distinct, do we have to look at fair value? Doesn't matter. If the goods or services are not distinct here, we are anyways going to net it off. So whether it is at fair value or above fair value, it doesn't really matter. It doesn't really matter. You are anyways going to net it off. Okay. So have you understood this part? Absolutely clear. Yes. Very clear with this. Yes. Ambika, 21st February, can we have a session? 28th February also is fine. I understand it, but I think the institute's schedules are fixed and even I am not there on 21st or 28th. Anyways, I will discuss it with the institute and let you know. Okay. In case you have any doubts, probably after viewing the recorded lecture, in case you are having any recorded lecture, you view the recorded session and you have any doubts, in that, we can definitely meet up. Okay, we can definitely meet up, but I do not want to disturb the schedule of the institute. Okay, so therefore, you view the recorded session. I will try to keep it as simple as this. Don't worry, I won't hurry up. Okay, if you have any doubts, you can always ask me. And if you request for an additional session for the recorded session, that is the doubts relating to the recorded lecture, we will definitely address it by way of a live session. Okay, it could be on 28th as you have said, but I cannot commit the date today. Okay, so I can only commit after the institute schedules it. Okay, so therefore, if there are any doubts relating to tomorrow's recorded session, please watch it. Keep the doubts Others also who are watching, if you have any doubts, you can definitely ask me. It's not like we complete the portion and we leave you. There is going to be a hand holding. Okay, so therefore we will be there. You write us for the doubts, and if at all you feel that an additional session is needed, a live session is needed, we will be happy to arrange for it. Okay, we will be happy to arrange for it. Okay, anyways, now this part, is it clear, everyone? Yes. Fair value treatment, above fair value, at or below the fair value. Is this concept clear? Yes. Is this concept clear, everyone? Yes. Anjali, Ambika, Purushottam, and all others who are watching. Have you understood this? Yes. Have you understood this part clearly? All right. Ambika has confirmed. Anjali, Purushottam, just these three guys are there today. Have you understood? Yes. Okay. So now, just a small flow chart, or what you call a chart for this transaction. Payments to customers. Distinct goods or services. Not distinct goods or services. So if it is not distinct, what you will go? You will net off. You will net off revenue against expenses. You will net off revenue against expenses. Okay. That means what? In effect, reduce from transaction price. Reduce from transaction price. Yes or no? Netting up. That means, does fair value, above fair value, below fair value make a difference here? And the answer is no, it doesn't. Okay. So, sale, purchase, or sale or payment to customer can be at fair value, above fair value, below fair value, makes no difference. Makes no difference. This makes no difference to us. This makes no difference to us. Is it okay? Yes. You can make it at fair value, above or below. Ultimately, what is going to happen? You are netting it off. So whatever you do in this case, it doesn't really matter. Here it matters. Distinct goods or services. Consideration exceeds fair value. Consideration at or below fair value. Consideration at or below fair value. What will you do? If this consideration exceeds fair value, what will you do? You will account for excess portion as reduction of transaction price. Remainder treated as purchase. Remainder treated as purchase. Is it okay? Yes. And if consideration is at or below fair value, will you do any adjustment? And the answer is no, you need not make any adjustment. Why is that so? Because your revenue is not getting inflated. Revenue not inflated. Therefore, treat as purchase and revenue without any adjustment. Without any adjustment. Is it okay? Yes. Have you understood this? Payments to customers, is it clear? Yes, no, all clear, not clear. All clear? Noted down? All well? Yes. Anjali Purushottam, just confirm. Okay. So you can just write the figures in this case. 110 in our example. Excess portion was 100. Remainder treated as purchase was 10. Reduction from transaction price. Reduction of transaction price. This we made it as 140 minus 100 is equal to 40. Okay, so these were the figures. So when you co-link with the figures, you will be able to understand better. When you correlate with the figures, you will be able to understand better. Okay. Guys, your responses, please. All clear? Anjali, Ambika. ठीक है? Yes. So can we take a break now? Yes, we take a 5-minute break. We meet by 9:10. Okay, it's about 9:05 almost. So we take a 5-minute break. We have completed this part. There are some questions which some I will do, one or two I will do, one or two I will give it to you to do. Okay, it is a simple question. You know the theory now. So therefore you can manage those questions. Okay. So we take a 2-minute break, 5-minute break, sorry. At 9:10, we will resume and continue with the standard. Okay. So that's it for now. 5-minute break, please. Okay. Jay? 5-minute break. concepts are clear. Purushottam has said where the fair value is greater than selling price or less than selling price, we treat as additional financing in the case of leases, but here the adjustment should be made. Yes. So concept is clear. And will there be any revision classes? Okay, Sharad from Ambikapur. Oh, thank you, Sharad, for clarifying. And Harshad, will there be any revision classes for old course for May 2021 exams in March or April? That I think, friend, you will have to ask the institute only. I cannot comment on that because I am not aware. All that I know is I am a part of this virtual learning sessions for the new course, and that is going on at present. Okay, so you can clarify with the institute or with your local chapter if they are conducting anything for the benefit of students, because what I remember was when the pandemic was in full force, lot of student association chapters conducted lot of sessions for the benefit of students. So if at all they still have such things, my suggestion is please contact the local chapter for further guidance. From the board of studies for old session, I am not aware right now. Okay, so that is all that I have to say. Okay, so we have discussed now the last concept, that is payments to customers. So let us take a quick look at the questions. Yeah, this is done. Consideration payable to a customer. Okay. So example 5 is there here. There is a slight, my opinion again, that this answer is not correct. Okay. But we'll read the question and you will understand why this answer is not right. Okay. A producer entity sells energy drinks to a retailer, a convenience store. The producer also pays the retailer a fee to ensure that its products receive prominent placement on store shelves to attract the customer's eyeballs so that chances of sales of its products are higher. That means what? There is a priority that is assigned to the energy drinks. Okay. So there is a priority. So in my view, it is a distinct service. Okay. The fee is negotiated as part of the contract for sale of energy drinks. In this case, the producer should reduce the transaction price for the sale of energy drinks by the amount of slotting fees paid to the retailer. Producer does not receive a good or service that is distinct in exchange for the payment to the retailer. This is one thing that I am not very much convinced about. Okay. If you have given prominence, if you have given priority, if you have given right to the selling entity, then there is a right for prominence. Okay, so at any point of time in those slots, in those racks, only these energy drinks will be placed. So if that is the case, they have to be grossed up. However, if we read this solution, it appears that there is no such right that is given. Today I will place the slots on a place of prominence. Tomorrow, if I find out that sales are not happening, I will remove it from the prominent place and put another product in its place. If this is that kind of an arrangement, then actually there is no prominence. So therefore, this is a particularly what you can say dicey question. It can be answered both the ways. So they have said producer pays a fee to ensure that its products receive prominent placement. That means somewhere my interpretation is there is a priority that is given to the customers, to the seller's products. There is a priority of place. There is a distinction that is there. There is an earmarked space for it. So I feel if this is the interpretation, this has to be taken as a separate, distinct service, and accordingly, you cannot net off. You will have to show it as gross. However, if this placement can be changed by the retailer as and when he wants, then in that case, there is no prominence given. You are not given any space at all. So therefore, what you will do, you will show net. Okay. So this one question, I am a little bit shifting here and there. Okay. Because the question could be worded better is what I feel. Okay. Anyways, we'll be writing to the institute. So if they can issue any corrigendum or clarification on this, it will be helpful for us. Okay. Example 6, I leave it for you for homework. Please do it. Illustration 52, a simple one. We'll read it orally. You can solve it orally. Okay. An entity that manufactures customer goods enters into a 1-year contract to sell goods to a customer that is a large global chain of retail stores. Okay. Something like Walmart. The customer commits to buy at least 15 crores of products during the year. The contract also requires the entity to make a non-refundable payment of 1.5 crore to the customer at the inception of the contract. This 1.5 crore payment will compensate the customer for the changes it needs to make to its shelving to accommodate the entity's products. I told you, slotting charges and prominence. Okay. The entity does not obtain the control of any right to the customer's shelves. That means there is no right on the shelves. See, there are two ways. One is if you take a seller like Walmart, they can place the products wherever they want. Like, for example, if you are a company, a chips company, for example, what you can say, which is that brand Lay's or whatever it is, then the Walmart can decide Lay's can be put along with any goods. Okay, so Lay's will go along with Bingos, along with Bingo Mad Angles, all those things, it will go together. If that is the case, there is no prominence. But suppose the Walmart gives you shelves dedicated, and on the shelves it puts your branding. This shelf is dedicated to Lay's, so Lay's stickers, Lay's advertising is done, and your products are placed only there. It means you as a company are having right on those shelves. Okay, whenever you inspect, you can watch that on those shelves only your goods are there. So if that is there, it is giving a right to the space. If it is giving a right to the space, then it becomes distinct. Here it is not giving any rights, so therefore it is not distinct, and therefore what will be the transaction price? 15 crores minus 1.5. That is, here the transaction price will be 13.5 crores. Here it will be 13.5 crores. Okay. Now, the next illustration 53, customer C is in the middle of a 2-year contract with the telco B Limited, its current wireless service provider. Okay. So B Limited is a wireless service provider to C. Okay. So wireless services. All right. Next. If C cancels the contract with B Limited and signs a 2-year contract with D Limited for 800 per month, then D Limited promises at contract inception to give C a one-time credit of 2000, referred to as a port-in credit. The amount of port-in credit does not depend on the volume of services subsequently purchased by C during the 2-year contract. Okay, so now what is happening? There is a port-in credit that is being given. Okay, so C wants to terminate the contract with B and wants to go into a contract with D Limited, D for Delhi. Okay, so therefore, how do you treat this? Okay, let me read the question once. C is in the middle of a 2-year contract. Okay. All right. Stop the share. Yeah. Now, there is an existing contract between C and B. Okay, for wireless services. Now, C wants to terminate its contract with B. It is as if like you are a customer who is a customer of Airtel, for example, and you want to port to Jio. So this is like that. C wants to port to D. So now the service provider will be D Limited. So wireless services will be provided by D. In return, C will pay how much? 800 per month. 800 per month. All right. This is the payment that will be made. What is the duration of the contract? Duration of the contract is 2 years. Duration of the contract is 2 years. Because of this, D Limited is giving a port in credit. That means what? D is saying, we welcome you to join our services. We will give you 2000 rupees port in credit. Okay, so CD. Now what is happening? D Limited is giving rupees 2000 port in credit. That means what? It is like a payment made to the customer. It is like a payment made to the customer. The question now arises, should you net it off because they are not distinct, or should you gross it up because they are distinct? So basically the question that we are trying to answer is this port in credit a distinct service? Is this a distinct service? Okay, it is like saying if you join Jio from Airtel, Jio will give you 3 months free data no matter whatever you consume. Okay, Jio will give you 3 months of data no matter whatever you consume. Is it a distinct supply? Is it a distinct supply that is being given, or is it a part of the wireless services? It is a part of the wireless services. They are integrated. It is like a welcome scheme that is being given to the new customer. So what you will do, there is no distinct service that D is receiving. D is not getting anything. D is only getting C, who will anyways be making the payment of 800 into 24 months. So therefore, since in this leg, D is giving 2000 worth of credit, but in return is not getting any distinct benefit. The only benefit it is getting is C Limited agreeing to port in and take the wireless services at 800 per month. Apart from that, is C giving anything to D? And the answer is no. So therefore, will you gross up the revenue? Answer is no. You will net it off. So 800 multiplied by 24, 19,200 minus 2,000. So what will be your transaction price? Your transaction price will be 17,200. Your transaction price will be 17,200. So essentially, you know what we are looking when payable to customer? Two things we have to look. Number one, we have to look at whether the goods or services received by the seller is distinct in the context of the contract, distinct as per what we have seen in the step number 2. And second one, if they are distinct, whether they are at or below fair value or above fair value. If that is above the fair value, you have to do the adjustments. You have to do the adjustments. Okay. So with this, we come to an end of the biggest step in the 5-step model, that is determination of the transaction price. The big step is over. Now the next step is a small one. It will take hardly 15-20 minutes. Okay. So step 4. What is step 4? Allocating transaction price. Allocating transaction price to performance obligations. To performance obligations. Yes. Please remember, अभी तक हम रेवेन्यू पे पहुंचे ही नहीं है. We have still not yet reached revenue recognition. We are still moving in the precursors to revenue recognition. Okay, so revenue will come as a last step. Right now we are still determining the various things. Okay, so allocating the transaction price to the performance obligation. How will you allocate? Well, the standard has given clear guidance. You have to allocate based on standalone prices. You have to allocate based on standalone prices. You remember the very first day, the first question that we did, air conditioner 44,354, warranty 3,226, and servicing was 2,419. Total of this came to 50,000. How did I get these figures? Well, I allocated the transaction price. Transaction price was 50,000. I allocated it based on their standalone selling prices, which was 55,000 for the AC. For the warranty, it was 4,000, and for the servicing, it was 3,000. This total came to 62,000. So I allocated 50,000 in the ratio of 55:4:3 and arrived at my prices, So the basis for allocation, is your standalone selling prices. Okay. Now, when we talk about standalone selling prices, what does it mean? That is important. Okay. First thing, it means the prices that are observable if the seller himself has sold such items as a single performance obligation. That means what? That means if seller sells the product as an individual performance obligation, the selling price of that will be the standalone selling price. In this example, the AC company sells AC independently, sells warranty independently, gives the servicing independently also. So therefore, 55,000 becomes my standalone selling price. 55,000 becomes my standalone selling price. Warranty becomes my standalone selling price. Why? Because I am providing. So first preference goes to what? First preference goes to my own selling price of the product if I sell it individually. This is the first method. The second method, if I do not do it individually, I will go for a market assessment approach. Which approach? Market assessment approach. What do you mean by market assessment approach? Market assessment approach means I will look at my competitors. I will look at what they are offering, and based on that I will do my offering. Sir, but ye ho sakta hai na that my competitor may have certain conditions quite different from mine. Like for example, let us assume that you are a small AC manufacturer and you do not sell ACs independently. You always bundle them up with warranty. Okay. So you do not sell ACs independently because you are so small that nobody will buy your AC only. They will come to you only AC plus the warranty. So they will buy with you. So therefore you are selling AC along with warranty always. So for you, AC is not a standalone product. So therefore, first option, standalone price determined on my standalone selling price, this option will never come. Why? Because I always club it with a warranty. So now what I will do, I will look at other companies who sell ACs. Like for example, I will look at Tata Hitachi, for example. Okay. Now Tata Hitachi is a very huge company. It will be having certain certain costs, certain margins that are unique only to a company of that stature. So what you will do, you will take their standalone selling price, adjust it for any changes that are visible to you in respect of the operating conditions, operating costs, margins, etc. And once you adjust it, you arrive at your price. You arrive at your standalone selling price based on the price of your competitors. You know, in transfer pricing, we used to refer this as the CUP method, comparable uncontrolled price method. You remember this? Yes, you would look at the transaction price of your competitors, do the adjustments for your what you say, do the adjustments for your capital structure, for your operating cost, for your assets structure, and then arrive at the cost. This was nothing but the CUP method that you used to follow in transfer pricing. Okay. And the third method, if competitors are also not providing and you are also not providing, then the next approach is adopt cost plus approach. Okay. What is the cost of your product? Well, you would know that, and to this cost you would add a profit margin. This cost plus approach is also there in your transfer pricing. Okay. But remember, this is the hierarchy. First thing, look at whether you are selling the goods independently. If you are selling, take that as the standalone selling price. If you are not selling, move to the next method, that is market assessment approach. That means what? Look at your competitors' standalone prices, adjust them for certain differences in the operating structure, whatever it is, and arrive at your price. If even that is not possible, your competitors are also not selling independently, then adopt a cost plus approach. As the final step. Okay. And if all these three is not possible, if all these three are not possible, what you will do, you can adopt residual approach. You can adopt residual approach. Suppose I cannot find standalone selling price, comparable method also is not working, and my cost plus method also is not going to work. In such scenario, you will adopt residual approach. What do you mean by residual approach? In this case, 50,000 was your price. Your warranty cost was 4,000. This was 3,000. So if you want to know the price of the AC, take it as a balancing figure. It would come to 42,000. It would come to 43,000. Sorry, it would come to 43,000. Okay. So this is what would be your residual approach. What price you are finding? If you know all other prices, take that as the balancing figure. Take that as the balancing figure. So this is the importance about your standalone selling prices and how to find them. How to find them. Okay. So first step is always go for allocation based on standalone selling prices. If that is not possible after exhausting all these criteria, then and only then you will move to residual approach. Then and only then you will move to the residual approach. Okay, because the standard does not want you to take your standalone prices or basis of allocation as a balancing figure. It wants to give you a fair value accounting kind of approach. It wants you to identify what is the value that you expect to receive. The value that you expect to receive cannot be a balancing figure if you are having standalone prices of a same product that you are selling or which is sold by a competitor. So therefore, the standard does not want a balancing figure approach. However, if all these three fails, then and only then you will go for a balancing figure approach, that is your residual approach. Okay, now we did this allocation 44, 354, 3,226, 2,419 based on individual standalone selling prices. Based on individual standalone selling prices. Now it is possible that there may be allocation of discounts. There may be discounts. So what would you do in the case of discounts? The standard tells in the case of discounts, you will have to look which products are discounted. You will have to look which products are discounted, and based on that, you will have to do the allocation. Based on that, you will have to do the allocation. It's not that you take the discounted value and do the allocation directly. Okay, you have to take the allocation of the discounts into consideration before doing the allocation to the entire performance obligations. Okay, so let us take the case. So normally it is pro rata basis. Normally it is proportionate basis. But if discounts come, then the allocation can become disproportionate. The allocation can become disproportionate. Let us take the help of an example. Okay, let us assume I have four products. I have four products A, B, C, and D, and the standalone prices of these products. The standalone prices of these products are 15,000, 15,000, 10,000, and 10,000. Total is 50,000. Okay. Now let us assume, I'm just giving a normal example. Okay, first, then I will come to the discount. Let us assume if you bundle up all these goods and go to your seller and ask him, I want all the four. What is the best price that you can offer to me? Then he will say, look, the best price I can offer to you is 45,000 rupees. So therefore, your allocated price will be based on 45,000. This is your standalone prices. Okay. So now how you will allocate 45,000? Will you go for market assessment, cost plus, etc.? Not needed, because these products are also standalone in their own right. They are also standalone products which you are dealing with individually. So therefore, divide 45,000 in the ratio of 15:15:10:10. So how much does this come to? This comes to 13,500, 13,500, and next one is 9,000 and 9,000. Correct? So this is the basis of your allocation. This is the basis of your allocation. First one, combo offer A plus B plus C plus D together is just 45,000. So combo one, A plus B plus C plus D together is available for 45,000. A plus B plus C plus D is available for 45,000. Now it is also possible that I can say A and B are my pristine products. A and B are my pristine products. They are absolutely important, absolutely well performing. I need not give them a discount. I need not give any discount on those. But C and D are mediocre products. I won't say bad, but they are mediocre products. If any customer comes to me and asks for a combo of C plus D, then also I will give them a discount. So C plus D, if I bundle together, I will give them for 15,000 rupees. I will give them for 15,000 rupees. So now the question arises, how will you find the transaction price? This is allocation in case of one, allocated price in case of the second scenario. In case of the second scenario, how will I do the allocation? Now look, A, B, C, D, individually if you buy, it was available for 50,000. If you buy all four together in case one, it is available for 45,000, means you are giving 5,000 rupees discount. Now case 2, C plus D is available for 15,000. Look at the standalone prices. C and D is 20,000. C and D is 20, but when you combine C and D, it is available for 15. That means what? This entire discount of 5,000 is actually attributable only to C and D. It is not attributable to A and B. So therefore, in the second combo, I cannot do the allocation based on the original pro rata method. Why? Because entire 5,000 trade discount is only just because you are purchasing C and D together. It is just because you are purchasing C and D together, not because you are purchasing A, B, C and D together. The entity does not want to give any discount on A nor any discount on B, but it is giving a discount on C and D. So therefore, the discounted prices will be allocated only to C and D, not to A and B. Is it okay? Yes. So in the second scenario, your transaction price is 45,000, but how will you allocate the prices? Well, C and D is available for 15,000. So what you will do? 15,000 you will allocate in the ratio of 10,000 is to 10,000. That means what? You will allocate equally. Okay. 10,000 is available for 15. So 15,000 in the ratio of 1 is to 1. So how will you allocate? 7,500 here, 7,500 here. The discount is split equally between C and D, and A and B, there is no question of a discount. There is no question of a discount. Yes. So in the second case, have I proportionately calculated my discount or have I disproportionately calculated my discount? And the answer is, sir, you have disproportionately calculated the discount. Sir, why did you do that? Because you have to see which are the items actually suffering a discount. A and B are not suffering a discount because they are your pristine products. You are not giving them any discount. So therefore, they cannot be reduced in terms of their selling price, because discount to unko nahi ja raha hai. Discount is not going to A and B. Discount is going only to C and D. Only to C and D. So therefore, entire discount will be apportioned to C and D. So what will be the allocated prices of C and D? Divide 15,000 in the ratio of C and D's standalone selling price. That is 10,000, 10,000. So you will get 7.5, 7.5. All right. And A and B remain the same, 15,000 rupees. 15,000, 15,000. Did you understand? Yes. Have you understood? Have you understood this part? Disproportionate discounts. Correct. Sharad, your answer was correct. I'm getting your responses little later. Yes. Perfectly understood. Thank you, Ambika. Yes. Now we move on to the next example on disproportionate discount once again. Okay. Suppose any customer comes only for A and B. You will give him A and B for 29,000 rupees. Okay. This is combo 3. Combo 3. Okay. Combo 3. One comes for A and B. You will price it for 29,000. Whereas somebody comes only for C plus D, you will price it at 16,000. You will price it at 16,000. The question arises, just a second. The question arises, how will you determine the allocation? How will you determine the allocation? Okay. So again, what is your total discount? 29 plus 16. This is your transaction price. 29 plus 10, 39 plus 6, 45,000. So 45,000 is your, this is allocated prices in the case of third combo. All right, third combination. Now see, A and B are given a lesser proportion of discount. Yes or no? Their price was 30,000 together if they were sold independently, but you are giving them when they are sold in a combo only for 29,000. So now 29,000 will be allocated in the ratio of 15,000 is to 15,000. So how much will go to each? 29,000 in 15 is to 15 means what? It is essentially equal. So therefore 14,500 will go, and here 14,500. And what about this 16,000? In between C and D, it will go in the ratio of their standalone selling prices. 10,000 is to 10,000. So what is going to happen? This price will be 8,000 and 8,000. So what is your final price? Does it come to 45,000? Answer is yes, it does. So do not blindly go ahead and allocate the selling prices on the standalone prices. Look at any special information that is there relating to discount being allocable only to a particular good or service. If it is attributable only to a particular goods or services, you first allocate it to that. You first allocate the discount to such goods or services. If after such allocation, there is still some general discount that is there, then you allocate it based on the standalone selling prices. Did you follow? Yes. So with this, we have done the first exception, that is allocation in the case of discounts. Yes, Sharad. Good. 14,500, 8,000, 8,000. Okay. I have a nice combination. Ambika from Mumbai and Sharad from Ambikapur. Okay. Good. All right. Both have Ambika in their what you can say inputs. Okay. Anyways, it's good. Nothing to be taken from this. Okay. Just a small light moment for me. That's it. Okay. Don't take it personally. All right. So anyways, now this is done. We have seen how discounts are allocated. When you are allocating discounts, please look at which is the combo that is actually getting the discount. Do not go for blindly apportioning on the basis of standalone selling price, because when you go for blindly apportioning, chances are you are ignoring the discount component on the combo offer. Okay, so this is done. Let us move on to the next case, that is your residual case. Let us move on to your residual method. Now in this very scenario, let us assume that for some reason A is never sold as an independent item. A will always be sold as a combination with some other items. So therefore, B's standalone selling price is 15,000, 10,000 and 10,000. Okay, these are the standalone prices. Now the question that arises is, how will you do the allocation? If first case, combo 1, A plus B plus C plus D is equal to 45,000. Simple question. How will you do the allocation? Okay. Now let us come to the allocation in the case of residual method. Okay. Now, if you take all the 4 together, you are going to get it for 45,000. there is no combo offer between C and D. This is a simple question. This is a simple question. So how will you do the allocation? 15,000, 10,000, 10,000. So how much does it come? 15 plus 10, 25, 35. So this will be 5,000 balancing figure. Okay. So this is a case where you are allocating based on the balancing figure. You are allocating based on the balancing figure. All right. Did I do correctly? 15 plus 10. Okay, sorry. This has to be 10,000. 10,000. Okay. If nothing is there, if nothing is given to you, only A, B, C and D together is there for a combo offer of 45,000 rupees, it will be done accordingly. However, let us take the next combo offer. C plus D together is available for 15,000. This combo C plus D together is available for 15,000. Can you do this allocation? And the answer is no, you cannot. Because if you do this allocation, you know what you are doing? You are effectively taking the discount of C and D and allocating it to A. You are effectively taking the discount of C and D and allocating it to A. So what the standard says is, the standard says in the second scenario, what you have to do is first you allocate the discounts. First you allocate the discounts and then you allocate find the residual figure, and then you find the residual figure. So in the second scenario, your price is 45,000, but C plus D is a combo now. C plus D is a combo. You are giving a discount only on C plus D, not on B. So B will be at 15,000. C and D will now go as 10,000 is to 10,000. So therefore 7,500, 7,500, and then you allocate and then you find out the balancing figure. So 45 minus 30, this comes to 15,000. If you had to directly allocate, then the discount of 5,000 on C and D, ये discount था ना, this was available together for 15, means this discount of 5,000 is directly going and sitting in your A, is directly going and sitting in A. If you just take a balancing figure, so always before the residual approach, what you will have to do, you will have to first allocate all the discounted prices. First allocate all the discounted prices based on their respective standalone prices. And after you have allocated the reduced prices, only then you will allocate the residual value as a balancing figure. Only then you will calculate the residual value as a balancing figure. You see, in accounts or any field for that matter, balancing figures are always dangerous. Why balancing figures are dangerous? Because your hidden errors will go and sit in your balancing figures. Your hidden errors will go and sit in your balancing figures. Okay. So yeah, Sharad, your answer is right. 15, 15, 7.5, 7.5. Yes. Yeah, Ambika, I meant that only. Okay. Anyways, so these are the principles relating to discounts. Normally, how will you allocate? You will normally allocate your prices based on standalone selling prices, So it is possible that for a combo offer, you will allocate based on the selling prices of the individual items, based on the standalone prices of the individual items. However, if you are giving specific discount for specific goods, if you are giving specified discount for specific goods, first you will allocate the price to those goods, and then you move to the general category. You will then allocate any residual discount or any residual value to the general category. Okay, so first go for specific, then you move to the general. Okay, so this is the principle regarding then you will be having your allocation in that particular manner. Anyways, this completes discounts. But there is one principle that is left here. It is valid for all. Okay, not only for these discounts. In general, it is valid. You have to see that after you allocate the prices, ultimately, what is the definition of transaction price? The transaction price is the amount that you expect to receive from the goods or services, the amount that you expect to receive from the goods or services. So in this case, when you allocate 15, 15, 7.5, 7.5, you as the entity must expect to receive this. You as the entity must expect to receive these amounts. Sometimes it may be possible, you will see in the example that we do, it may be possible that after the allocation, some of the prices that you have allocated do not fall within that range, do not fall within the range that you expect. If that is the case, you will have to do alternative methods of allocation. You will have to do alternative methods of allocation. Okay, so with this, let us come to your questions and have a look at what is given. Okay, yeah. Illustration 54, you will be doing it yourselves. What is given? They have given entered into a contract to sell products A, B, and C in exchange for 10,000. So 10,000 is the selling price for all the three put together. Standalone prices are given in the table: 5,000, 2.5, 7.5. They have told that product A directly observable means entity deals in product A. Product B 2.5, they had to follow adjusted market assessment approach, and product C they had to take 7.5 based on cost plus approach. So now the question arises. How do I allocate? No specific combo discounts, etc. You just have to allocate 10,000 based on the prices 5,000, 2.5 and 7.5. That's it. There is no other change in this. It's a simple question. So illustration 54 is all yours. It is all yours. It is possible that one product can be my own product which I sell, another may be market assessment, another may be cost plus assessment. That is your choice. So 54 is a simple problem. Divide 10,000 in the ratio of 5,000 is to 2.5 is to 7.5. Okay. Next one is illustration 55. This is important. This is important, or is it simple? I think it is simple. You can have a look. Okay. Now, an entity regularly sells products X, Y, and Z individually, thereby establishing the following standalone selling prices. Product X is 5,000, Y is 2.5, Z is 7.5. So X, Y, Z, 5, 2.5, 7.5. 5,000, 2,500, 7,500. Total of the standalone prices is 15,000. In addition, wait a minute, I think I'm sorry, I have made a mistake. Just a minute, let me rectify the mistake. Please. Give me 2 minutes. Okay, yeah, data was wrong. Yes. So now share the screen. Yeah, this is the question. Okay. Now, an entity regularly sells the product. So X is 50,000, Y is 25,000, and Z is 45,000. So this comes to 1,20,000. Okay. In addition, the entity regularly sells Y and Z together for 50,000. So there is a combo offer here. Y plus Z is equal to 50,000. Y plus Z is equal to 50,000. Case A, allocating a discount to one or more performance obligations. The entity enters into a contract with a customer to sell X plus Y plus Z in exchange for 1 lakh. The entity will satisfy performance obligations for each of the products at different points in time, or Y and Z at the same point of time. Determine allocation of the transaction prices to Y and Z. So how will you do the allocation? Simple. 1 lakh rupees is the combo for X, Y, and Z together. But Y and Z are already sold for 50,000. So you will have to allocate 50,000 in the ratio of standalone prices of Y and Z. The standalone prices of Y and Z are 25,000 and 45,000. So you will have to allocate 50 in the ratio of 25 is to 45. Okay. So when you allocate, you will get the answer, and X will anyways be sold for balancing figure 50,000 rupees. X will be sold for 50,000 because Y and Z together is 50. Total X, Y and Z is 1 lakh. So 1 lakh minus 50,000, X will be 50,000. This is a simple question. I'm not going to solve this, but the case B is important. Okay. So case B I will be doing. Residual approach is appropriate. The entity enters into a contract with customers to sell X, Y, and Z as described in case A. Okay. So now the contract also includes a promise to transfer product alpha. Okay. So total consideration in the contract is 1,30,000. The standalone selling price for alpha is highly variable because the entity sells product alpha to different customers for a broad range of amounts, 15,000 to 45,000. Well, it really depends. See, there are some markets where it all depends on your bargaining power. Okay. So for example, you go to a tourist destination. In that case, it all depends on how you bargain. Okay. Like I come from Goa. So if you go to a place like a beachside markets, then it all depends on how effectively you can bargain. So if suppose you want to buy an item for which they are selling for 1,000 rupees, if you are a good bargainer, then you can get it for as low as 300 rupees. If you cannot, you may get it for 900 rupees. So it all depends on how effectively you bargain. So there is a wide range of prices between 300 to 900. So therefore, in this case, there is no single standalone selling price that you can attribute to the product. In this case, alpha is one such product. Alpha does not have an identifiable standalone selling price that you can point and fix that yahi iska selling price hai. You cannot say that. It will be a range of prices between the range of 15,000 to 45,000. So therefore, what you will have to do is you will have to allocate the transaction prices based on the principles we discussed. If based on those principles, it comes to a range between 15 and 45,000, my allocation is acceptable. If it is not within 15 and 45, if it exceeds or goes below that range, then well, the allocation is not acceptable. You will have to look at the alternative. So now determine the standalone selling price of products X, Y, and Z and alpha using the residual approach. Okay. So now case B. Facts continue to remain the same. Okay. So X, Y, Z, 50,000, 25,000, 45,000. Total is 1,20,000. All of them together, X, Y, Z, and alpha together, the consideration is 1,30,000. Together, the consideration is 1,30,000. So, how will you do the allocation? And the answer is okay. This looks like this. Sharad, your answer is correct. Okay. So now pay attention. This is the case B. Okay. Case B. X, Y, Z, 1,20,000, 1,30,000 is total. So will you say that alpha is having a price of 10,000? And the answer is wrong. Why you cannot say? Because you have not allocated the discount that is already there for combo Y and Z. Y and Z together are available for how much? They are available for 50,000. So first you have to allocate 50,000 between Y and Z in the ratio of 25 is to 45. So correct allocation is allocated price. If it is correct is, well, your transaction price is already 1 lakh rupees. If you take X, Y, and Z together, out of that, when you allocate 50,000 in the ratio of 25 is to 45, what do you get? 50,000 into 25 divided by 70, 17,857, and here it will be 50,000 into 45 divided by 70. That is 50,000 into 45 divided by 70. So that comes to 32,143. And in any case, X was 50,000 before. So this was your allocation. Now the total with alpha is 1,30,000. Total with alpha is 1,30,000. So now residual approach 30,000. Is it appropriate value? Yes, because alpha is known to have a price fluctuating between 15,000 to 45,000. So when the price fluctuation is between 15 to 45, all that you have to see is, am I falling within that range? If I fall within that range, then my allocation is appropriate. The residual approach is appropriate. Now, in the case C, this is case B. This is case B. Now, in case C, what they are asking is, suppose the transaction price for A, B, C, alpha together is not 1,30,000, it is 1,05,000. In which case, price to alpha will be how much? 5,000 rupees. Case C, allocated price will be 50,000, 17,857. 32,143. This comes to 1 lakh. Okay. And then you have total transaction price 1,05,000. So this comes to 5,000. This comes to 5,000. Okay. So now the question arises, is this 5,000 a suitable manner of allocation? Is this 5,000 suitable? Let us look at the question. Okay, now see, the same facts as in case B apply to case C, except that the transaction price is rupees 1,05,000 instead of 1,30,000. So now, if you follow residual approach, C is getting 5,000. C is getting 5,000, but the range of prices that the management expects from alpha, is between 15 to 45,000. Your price of 5,000 is out of the range of 15 to 45,000. So therefore, this allocation of prices is not appropriate. You will have to choose an alternative method. Please select the alternative method and do the allocation. Is it okay? So with this, we complete discounts. We complete allocation of prices in the case of discounts. So important thing is what? Normally you allocate based on standalone prices. However, so that will be a pro rata allocation. However, when some products have a higher discount, others have a lower discount or no discount, the allocation will be proportionate in respect to only those bundle of goods which have the similar rates of discount or are given as a combo offer. So therefore, in such cases, when you look at all the products together, A, B, C, and D in our example, all the products together, your discounts will not be on a pro rata basis. They will be on a disproportionate basis. But is that basis correct? And the standard says yes, that basis is correct because the discounts are in that fashion. Manner. Okay, so this is how you will do the allocation to find the standalone selling prices. Normally, flagship products, you do not get discounts. Okay, but the non-flagship products, they are willing to give a discount. So do the allocation based on the standalone prices of the non-flagship products. Okay, so this is how discounts allocation will be done in the case of discounts. So first thing, proportionate. It may be disproportionate in case of discounts one, and the last one is it may be disproportionate in case there is variable consideration. Let us take the case of a contractor who has received a contract from the government to build and maintain the roads. A highway stretch is given to him. He has to build it, maintain it, ensure that it is free from potholes and any such item. and he will be given consideration for the building as well as the maintenance, for the building as well as the maintenance, building of highway plus maintenance. And he is given a consideration. He is given a consideration. Let us assume building plus maintenance together is 500 crores. Building plus maintenance together is 500 crores. At the same time, he is given a performance bonus. He is given a performance bonus that goes like, suppose you build this highway within a period of 2 years. Suppose you build this highway within a period of 2 years, you will get an additional 25 crores. You will get an additional 25 crores bonus. Is this bonus attributable to the maintenance component of the highway contract? And the answer is no. It is attributable only to the building of the highway, and therefore this variable consideration of 25,000 will be allocated entirely to the highway construction, not to the highway maintenance. But at the same time, you have to remember variable consideration. So variable consideration, what were the rules we studied? The rules were, you have to see whether this consideration is subjected to constraints or not subjected to constraints. If it is not subjected to constraints, that means what? You have past experience in this activity. This is within your control. You know that this will accrue to you because you are sure of completing the highway within 2 years. If all these conditions are fulfilled, you will take this 25 crores in your transaction price. So therefore, entire 25 crores will be allocated straight away to the highway, not to the maintenance activity. However, if this is subjected to constraints, that means what? You do not have any experience of highway construction. So therefore, you cannot predict whether you will complete within a period of 2 years. Then do not include 25 crores in the transaction price. So please remember, these steps are hierarchical steps. Okay, you cannot skip one step and go to the next one. Okay, so for 25 crores to accrue, I have to first see whether it is subjected to constraint or not. After assessment of that, I can assess where do I allocate it. Since it is entirely related to a building of a highway, it will be allocated entirely to the highway. It will be allocated entirely to the highway. Is it okay? So to the construction of the highway, not to the maintenance. Is it okay? Did you understand? Yes. Have you understood? Yes. And at the same time, even after this allocation is done, you again have to check whether the allocated prices, they represent management's expectation of the prices that you expect to receive, management's estimation of the value that you expect to receive. If they represent the expectation of the value that you expect to receive for the performance obligation that you perform, then the allocation is acceptable. If it is not a fair representative, then you have to do alternative methods. Is it okay? Yes. Have you guys understood? Yes. Sharad, Ambika, yes. Yes. Okay. Case B. Correct. Your answer is correct in case B. Okay. You have written rupees in thousands, took a time to figure it out. Okay. So can we proceed further? You guys are still there? You want me to continue or we close for the day? Can I take just a couple of minutes or is it enough? Ambika, Sharad, Anjali is not there in the discussion. Purushottam is not there. Yes. Okay. So the allocation part is almost done. Okay. So tomorrow what I will be doing is I will be discussing step number 5. And I'll be completing step number 5 tomorrow. Okay. So I don't think I'm getting any responses. So what I will do is I will do this small question on variable consideration also tomorrow. It should not take much time. You guys will be able to follow. Now, one request from all of you. The request is, please watch tomorrow's recorded session. I will be doing it in the same manner like how I do. Okay, don't think that recorded session means, I will sit and read the standard. I will not do it that way. I will do a regular recording session. Only thing is the interaction that we have will be missing. Okay, so apart from that, yeah, it will be a regular session. So if you have to ask me, I would suggest please watch the session. And if you still feel the need for a live session, if you still feel it, if you okay, so all right, so acha, we got the I got the response, but we can, step 4 is almost complete. There is just one problem that is there which I have to do. It may take about 10 minutes, so I think it will cross my time assessment. Okay, because what is happening, the foundation classes also happen on the same meeting IDs, so I will be encroaching upon their time. Okay, so that is the reason I do not want to encroach on their time. It takes about 10 minutes. Okay, so I will not encroach on their time. If I extend a little bit, they will be in a little bit of stress. Okay, so I will do. It is a very small question. It is a very small question. You will be able to understand it. You will surely be able to understand it. Okay, so I will teach it as if I do it normally. So my understanding is, please watch the recorded sessions tomorrow, and you know. If even after watching you still feel that you would prefer a live session, I will do a live session. Okay, but it is subjected to approval from the institute. You can communicate to the institute in the feedback form. Okay, the feedback that goes, or you can write on the email ID that I shared yesterday. What is the email ID that I shared? Just a second. fr-final@icai.in. Okay, please share anything that you want. Institute will certainly agree if you people are really wanting, but I will ensure that I will do it, give justice to the topic. Okay, so this is our interaction up till today. Yes, it has been a very what you can say, fruitful interaction with all of you. Yes, and I really thank all the students who have attended these sessions. Yes, I do hope that you people get more and more benefits through this initiative of the institute. Yes, uh, ask your queries, give your feedbacks, suggestions, how we can improve. Okay, if you find a setup is lacking, mine is a basic setup. If you find some improvements, please suggest. If the teaching methodologies are you want something else, please convey to the institute, convey to me through this email ID, or convey directly to the institute. If any topic you have not understood, or you find certain more clarity is needed, or any suggestion that you have, please communicate to the institute your faculty, your feedback. Okay, it is very important, your feedback, because that will tell us how we should chart our path ahead. Okay, so that is why you people are going to do it. Okay, with this we close today's session. Yes, thank you for all the past interactions that we had in the last 2022 lectures. Okay, it has been a great learning experience for me, and I'm sure that all the learned faculties of all the subjects here are definitely enriching your learning experience. So take maximum benefit of this. I if we meet again, well and good, but if we don't meet again, I wish all of you the very best in your examinations. Answer your examinations with a clear mind. Do not go with stress. Yes, you people have studied a lot. You people have understood. You people have been very cooperative in your teaching, in your interactions, and it has really made teaching for me a pleasure. All right, I was also skeptical how the online batches will progress, because all I have in front of me is my webcam, and I have to see myself only. I have to see myself only. So therefore, my You have made life easier for me through your interactions, and I thank you for that. At the same time, I'm also thankful to the institute, the board of studies, for giving me an opportunity to present my views before you. Okay, so that's it for today, friends. We end the session, and watch the recorded one. If at all you need the live one, I will be there. Okay, but communicate it to the institute. Okay, communicate to the institute. Okay, thank you everyone. Thank you Shriram for your feedback. Thank you everyone. And yeah, watch the recorded session. Watch the recorded session. Don't skip, because till now we are not recognized revenue. We are going to recognize revenue tomorrow, so please watch the recorded session. Abhi tak jo kuch, it is like you have practiced, and if you don't watch recorded session, you are not running the Olympic race. You are all geared up for the Olympic race, so watch the recorded session. I'm sure you will win each of your Olympic races. So please don't compete with others. Ensure that your understanding is there, your conceptual clarity is there. Okay, remember this in mind. With this, I close for today. Okay, thank you everyone. Thank you so much. Thank you Ambika. Thank you Sharad. Thank you. Okay, all right, thank you everyone. Jay.